Alan Sanchez.
Present.
Mike Messina. Kurt Summer. Here. 8 present. We have a quorum.
Do we have a motion for approval of today's agenda?
So moved. Second.
All right, we've got a motion by Member Summer, second by Member Tejas. Any discussion? Motion before the council. Hearing none, can we take a roll call vote on approval of today's agenda?
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Donna White.
Yes.
UFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell. Alan Sanchez.
Yes.
Kurt Summer.
Yes.
8 in the affirmative. Motion passes.
About a motion to approve the February minutes.
I move that the State Investment Council approve the meeting minutes for February 27th, 2004.
Second.
All right, we've got a proper motion by Member Sanchez. We've got a second by Member Summer. Any discussion on the motion before the council? Hearing none, let's take a roll call vote to approve the minutes from February's meeting.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
UFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
8 in the affirmative. Motion passes.
Wonderful. Move on to agenda item 2A and hear from our SIO.
Good morning, Madam Chair, members of the council. Great to be with you here this morning. I'm going to be very brief because we have a lot of very important information to present to you in the remainder of the staff report. So I'll just get hit on a few highlights. First, the net asset value as of this last Friday was $53.3 billion. And the New Mexico WTI price for last week hovered around $82, up from $64 a year ago, obviously a significant increase. And our distributions for the last 12 months have totaled just over $1.5 billion. Again, we are projecting distributions for FY25 to be about $2 billion. We have an investment committee meeting coming up on Tuesday, April 16th at 1:30 p.m. We have an audit committee meeting coming up on April 22nd at 10 a.m. We also anticipate a governance committee meeting coming up. We don't have a date for it yet. We are awaiting a report from outside fiduciary counsel to provide guidance on the best fiduciary roles and responsibilities of both the staff and the council. We anticipate that report being presented to the governance committee, and we'll send out notice to the entire committee, to the entire council, if any of you would like to attend, even if you're not on the governance committee. I had hoped today to be able to announce 2 new hires. One of them is going to have to wait until next month. The other one, it's not quite finalized yet. We're still waiting for SPO to finalize the paperwork. But I am pleased to announce that we have, or are about to have, a new member of the management team. So I'd like to recognize Helen Tyndall. Please stand up so everyone can see you. Helen Tyndall is going to be our staff manager of our soon-to-be rapidly growing team. So thank you so much, Helen, for joining us in this role, and really look forward to working with you as part of the management team. And Madam Chair, I will stand for any questions.
We'll move on to agenda item 2B and hear from
Well, thanks, Madam Chair, and I'll also be brief. I'll start with a couple of months ago, we came before you and indicated that we've been working with the Treasurer's Office to potentially manage some of the cash that we have on our balance sheet. The Treasurer's Office has always been an option for us, but up to this point, we hadn't made any investment over there. So after lots of hours of working closely with them and their investment team, and thank you very much, Treasurer Montoya. It was a very good experience for my folks. We came to an agreement. We have a memorandum of understanding now, and so at that time I told you I'll come back to you if we can get something worked out. So starting next month, we'll invest $250 million per month for 4 months with the Treasurer's Office to get the balance up to $1 billion. Then as we work our cash balances down, getting capital calls and things, we'll begin to draw that back when it's necessary. But after almost 3 months of work together, we finally got an agreement and ready to take some action.
I would say this working relationship is good for New Mexico in a lot of ways. But one of them is saving about $1.5 million, keeping that money in New Mexico and invested. So I'm really appreciative of the relationship that we've been able to work together after so many years that the Treasurer's Office hasn't went to that site. So I really appreciate that. And we're ready for your money on April 1st, and it won't be April Fool's.
Yeah. Well, the real issue that kicked it off was J.P. Morgan had waived the fees on our cash account because interest rates were zero. But once interest rates have popped back up to where they are, they reinstated that fee. It's 18 basis. That's the fee savings that the Treasurer's talking about. The fee load at the Treasurer's Office much lower than that. And that's about it, Madam Chair. The economy's still pretty steady state. We're still seeing a big difference in some of the numbers are getting reported. Often we're getting reports, say real unemployment of a really good number, and then the next month it gets revised down. We're seeing that across the board. There's a big separation between gross domestic product, gross domestic income. Those two numbers, or those two measures, should be the same with small deviations because there's differences in timing of reporting. But there's about a 3% difference between those numbers now. It's never been this high. So there's still lots of stuff going on out in the economy. We're trying to keep our eye on it, but steady state from last time.
Questions for Vince? January report.
Thank you, Madam Chair, and good morning, everyone. Thanks for the lead-in comments. Today we have your January flash report. I see it up on the screen. And the first page we'll look at is on page 26. That's your capital market review summary page that provides you all the highlights in terms of what's been happening in the market, but also economic indicators, tying into some of the comments and metrics that we provided for you. I think if you look at the bottom right-hand table with the market performance heading, you'll see the performance for the 1 month period in particular. We tend to look at longer periods, but given that this is intra-quarter, just looking at it more short term, you'll see that we have more mixed results in January than what we saw for most of 2023 and in the fourth quarter where things just went up. So if you're seeing a little bit more differentiated return, although generally the market is a little bit quite supportive to the capital market, that is underscored by fairly resilient economic indicators that to consumer spending, consumption, but also on the labor front. Those indications have been, I would say, surprisingly resilient through this. That's been more patient, I think, than folks had hoped for in terms of lowering interest rates, and we've held those rates steady as recent as last week. And a lot of the risk assets supported by patient in that area, perhaps later this year, but we'll have to see. So for the time being, fairly steady state, as was mentioned, but seeing a little bit more volatility as this portfolio that you've built that really is designed to withstand volatility. It's not one that necessarily is designed to just perform well when markets are going up. So I think you have good positioning there as you start digging into some of the layers, large cap stocks, which has been leading the way all of 2023, and really you could share that down into the 7 stocks that's been titled Mag 7. Heard a lot about that. Most of those have continued to do well into 2024, although it's been more bifurcated for some stocks continue to do well. The one that everyone's heard of, but then others that have sort of fizzled out a little bit. So we're seeing some differentiated performance this year. Interest rates, the movement there, and small caps tend to be more interest rate sensitive, come under pressure as the rates have moved. So you can see there, Russell 2000 selling off about 4% in that month alone. But again, this is short time period. And then when you look at developed versus emerging, developed at the edge of both developed and emerging, which are exposed to FX or currency movement, been held back by a relatively resilient dollar despite us printing as much as we have been. Inflation has been trending down. It's not as low as I think anybody would like it, but has been trending down. That's been helpful as essentially had cash yields stay around 5%. So as this inflation's come down, cash yields stayed high at pretty attractive real yields. In fact, they're at 15-year highs. So any cash that you do have is not losing any purchasing power. That's a good current challenge to work through. I think Marcia's going to look and provide you with some additional detail on the individual asset class results, and you'll see that you outperformed really across the board. So this, as I said, is an environment is quite well. So happy to take any questions or comments otherwise.
I'll go to page 28 and just look at the January allocation and performance. Allocation is at the top, and we're showing land grant and severance tax. I think this is as of the end of January. I think staff has done some rebalancing since then. So you're probably, I'm sure you're closer to your target allocation again, where there is an interim target. We show the interim target and also the long-term target. So across throughout the report, we show those. But again, as I mentioned, I think staff's been doing some more rebalancing, so you're probably closer. I also want to point out that in the private equity and the severance tax, that private equity number includes both the in-state and the national in the severance tax. The performance is shown on the bottom, as Matthias indicated. You had outperformance in January, and therefore, if you look across the board through the 10-year, which is pretty much flat to the benchmark, you've had outperformance. For the land grant, a little bit different story for longer-term numbers. For the severance, the shorter term, severance has done a nice job of outperforming the benchmark as well. The following two pages look at 29 and 30. Look at those allocations versus the interim target and long-term target. I'm gonna skip that because we know you've gotten closer. I'm gonna take you to page 34, where we could just, as Matthias said, look at the asset class composites and performance. Again, we're showing land grant and severance at the top, and then we'll show the individual asset classes. U.S. equity compared to the Russell 3000. Since the transition of that portfolio, you now have a 3-year number that is in excess of the benchmark, so beating the Russell 3000 by 10 basis points. Is a 3-year. Longer-term performance reflects a different structure. Non-U.S., for the most part, has done a really nice job of outperforming its benchmark. The exception of that is the fiscal year to date. Just again pointing out, we're not going to go into heavy details in this report because it's a flash preliminary report, but with the non-U.S. market, like with the U.S. market, developed or large cap outperformed small cap. Small cap was actually negative, and the non-U.S. markets, emerging markets, was also negative. So to see outperformance for the combined asset class, the combined composite, is great to see. On the fixed income side, also outperformance across the board, actually, now for the public benchmark. The private, we've seen that below its benchmark now, but we now see shorter term that you're ahead of that. Leverage loans +2 by a basis point, but again, outperformance there. And then showing cash at the bottom of page 34. The following page is looking at the composite, but for the most part, these are not. This is a January report. This is a monthly report, so we don't have performance for your privates at this time. We're doing a quarterly report. But again, just showing, making sure that we show the council that we're now putting up front the ETIs and the severance tax state private equity program closer up in the report instead of further back. With that, I will also, let me just give you an update on November a little bit better. November, you were up, February, sorry, I don't know where it came up from November. February, where you were up 110 basis points just for the month, so that puts you for the quarter at 124 basis points. So this is for the total fund, we don't have it broken out by individual funds. And for the total fund, fiscal year to date, you're at 5.31%. Prior to the November.
Madam Chair, good morning.
Good morning.
As far as how much money we have in cash, what number are we at in total for the full portfolio? For all of the portfolios?
As of
About 8.
if you went to page 42, and this is as of January, though, we have that, I can look up in a moment preliminary report. This shows cash equivalents at, on the bottom of that page, page 42, at 7.475 billion.
Madam Treasurer, it's probably south of 7 now. Last couple months, we've had some nice draws.
Okay. And as far as the way that rates are changing and the economy is changing, what is our plan, or what is the perspective of how much cash we have on hand? Curious. We're talking about it quite a bit in my office.
So for rebalancing purposes, we've been using, so we've got a rate on cash, around 5.25, and a rate on the 10-year Treasury bond, which is around 4.25 now. So we've got a financial model that just says, is it better to hold cash or is it better to hold bonds? So we take a one-year look at what our probabilities of being in recession are, which we think the 10-year would come down to 2%. In a case like that, that would give us a big capital gain out of the 10-year bonds. So we put a probability on that, and it just sort of calculates how much cash, how much bonds should we hold now to have an optimal. So that's why we're at 7 relative to our excess bonds.
Okay, because I know we have an interim target allocation, and we're trying to get to that point for the rest of the cash that we're holding, but I attended a couple of conferences, and it made me start thinking about things a little bit in a different light. When we're looking at deals on the internal staff side, the idea of looking at diversity, equity, and inclusion within fund managers is important, and I know we've never really talked about that in SIC, but there's this idea that if you invest in either fund managers that have a lot of women or people of color, that you're taking away from performance. And all the data that I've seen so far is showing me that that's inaccurate, that in all actuality, you're getting higher performance by 600 basis points. So, for example, you have 11% earnings on a standard, 17% of earnings has been shown on the same standard, the same type of fund managers. So I really want us to start having representation that reflects this, not only on this board, but in the money managers that we're investing in New Mexico. And if we are comparing apples to apples and you're not losing performance or rate of return, everyone should be at the table. And so we're an example for people who are not money people. You know, when you go and look for an Airbnb in a place you're not familiar with, you don't necessarily need the pool. You need to make sure you have a safe, comfortable bed and the right spacing for what you need. That's your asset allocation, right? So I think we're taking out a big chunk of people that should be at the table because they do have the same type of performance. And so I want to hear what your thoughts are on that. Other states have had some internal documentation where they score people based off of performance, based off of years, everything that comes in, so that it's more of a fair playing ground overall. And being that we have so much in cash, and I met so many fund managers that were both people of color and women that are doing a very successful job in the United States. I've just not seen them in our packets. And so I didn't know they actually existed because it was overwhelming to see a room of 400 people that are in this space, and I've never once seen them in my packet. And so I don't want to get in the weeds of what is done internally, but maybe what's being done internally is not including all factors that need to come before this council moving forward. And so I wanted to talk to you guys about that, all of you. I want to talk to the council about that. It's really important to me that when we're investing, we're also looking at other factors. And of course, being a fiduciary is our number one priority. But if all things equal the same amount on rate of return and on risk, then we should be looking at that as well. And we have a fundamental responsibility, not only as fiduciaries, but as people of New Mexico, to make sure that we're investing wisely for our state and our tax dollars, and that we're also not becoming a part of the problem in keeping the gap between rich and poor in existence when it shouldn't be. Because from an economic standpoint, when you don't have a middle class, that causes you more chaos in your economy. And so just wanted to see what your guys' thoughts were, or perspective, or if anyone has been talking about this or has seen some of the models from other states of some of the thresholds that they use to help question people when they're coming before them and testing out all aspects, including ESG, but D&I is just as critical for me. Anybody. I mean, I just want to start the conversation here. I'm putting it on the table. Let's talk. You know, have we talked about it? Have we thought about it? Is this something we need to talk about at our workshop? Is this something we need to get our staff to get trained, or to see data that shows that everything we thought before is maybe inaccurate? Performance is never the problem of taking the risk. I mean, because if we all think that way, that's okay. But if the staff who's actually investing still doesn't think that way, or doesn't get the direction from us that, yes, this is an option and you're not going to kill your career because you decide to go in this position of trying to look at more fund managers that are of color or are women or are minority or whatever the case, what are we doing as the leaders to give the direction to the staff, and not only the direction, but giving them the confidence that it's the right thing to do and that you're not risking the rate of return?
I guess I would just say that we've done some research on that as well. Part of our clients and other clients are interested in similar initiatives. And I think you're right that they're not mutually exclusive, pursuing DI and ESG and pursuing return. I think there is always that sort of natural or at least perceived friction between the two, but it doesn't need to exist. I think most shops have expanded their research capabilities into this area to at least track that. We certainly have. The emphasis, I would say, is largely driven by the asset owners in terms of how much weight they want to place on that. But I can tell you that if all else equal, and when we're looking at a search and that's the metric that's in there, while it's not a driving metric, if you get to the end and everything all else equal, that can be a differentiator.
Can we track that?
So we do, yeah, absolutely. And I mean, even across your managers now, to the degree that they have CI metrics or experience there, or made it a certain effort to make progress, that's something that we track, and we could come back to you with at least a reporting of what you already have. Because again, I don't know that
We can do that on the public side.
Yeah, and I think there's recognition across the asset management industry that this is an important topic that lots of folks care about. So I think, and it's the right thing to do in a lot of ways. So I think they've made an effort to be able to speak to it and put a plan in place to make improvements where needed. So if you'd like some reporting on what you already have there, we're happy to help provide that or figure out a way to save additional.
I think, Madam Chair, I think it would be helpful for this council to know the breakdown based on the asset allocation of private equity or real estate, whatever it is, whatever bucket we're talking about. What is the breakdown of our fund managers overall? Because, I mean, I don't think we would be shocked where we're at today than where we're at, and maybe it's something we need to work on. And it's something we need to educate ourselves on, and it's something that we need to be more equitable on And when I say that, please don't be confused. I am not saying to risk your performance for it. What I'm saying is that it's insulting if we believe that fund managers that are people of color or are women have a worse performance than other fund managers when the data is showing us differently. And so for us, we need to put it all on the table, and then we need to be able to do an analysis that is based on everything fair and equal across the board, and then pick what's in the best bucket for the guardrails that this council has put on based on the asset allocation. Because since I've been here in January, I have not personally, and I've come to every meeting except when I have my surgery, have not seen a lot of that. And when I went to these national conferences, and it was a full-packed room of like the rainbow, and they're all fund managers, and I'm thinking, well, where are you? Where are you in my bucket? And I don't know where that disconnect is, but we need to reevaluate. And so I don't know if it's at our workshop we do, or what data we need, or we need someone to come and present to us and show us, or to the staff. But I want to make sure from my perspective, and it's just mine, it's not the council, from my perspective, I would appreciate us making sure that we're having a true analysis, so that it's not that we're giving a leg up, it's that we're giving a fair playing ground.
It is, I think it is direction from the council. But we do work with states and it's mandated state level.
From the state legislatures or from the state treasurer?
We have to go in front of the legislative body to work.
So can we just hear from Mr. Smith about, your sense of your asset class director's comfort level with looking at diversity metrics?
So, well, this isn't a new issue by any means. We've been talking ESG for, 2 decades probably, and DEI is a little bit newer, but these aren't new issues. I think, from our perspective, all of our managers are under the same sort of, thought process, and they're changing the composition of their staffs. So, not seeing it in your book, I have to disagree with you that our managers do have been diversifying their staffs along. So that's kind of that's sort of how we're participating, is in that our managers are working on it. Are we specifically looking for firms that are diversity headed? No, there's no mandate for us. We're looking for the best managers we can find. If it is true, and it very well likely is, as you say, then more of these firms will come pop into the top of our list if that performance is superior, because that's what we're looking for. I would also comment that we've got issues of our own. Our comp is not in line with the industry. With the increase of assets, I've got maybe 2/3 the people that would make the most effective team for us internally. There's other issues with, us bringing investments to the investment committee and then doing it again in front of you all and the time that takes. I'm wondering where the discussion is on that. That's right here at home. And if anything, we could have those discussions side by side, but we need to have that discussion about what's happening here at home.
And Madam Chair, that's a distraction from this issue, because you guys have been talking about that issue, and I'll tell you where I stand on it. I don't feel comfortable with it because this is not in place first. I don't necessarily trust what the decision-making process is, because I don't know what it is. But when I look at my book, I know that there's a lot of people that are excluded from it. I'm not saying to go looking for them. They're there. They've come to us. We've excluded them in a course of years. So I need a process that looks fair and equitable, that I can say, I vouch for this process. I still don't have an understanding of fees. We have in the 300 category, how much do we have in fees? 9 million? That we, just on contractual services?
10 to 12 a quarter.
Thank you, sir. So we have that just on the fee side that we can see. That doesn't include the fees that we're approving in each one of these fund managers, and we have never seen it. And when I've asked for it, I've been told, well, we report it to Legislative Council Services. So I think before it's putting the cart before the horse. We need to get to that point. I totally can agree with that, but we're not at that point because we haven't even put on our socks so that make sure we're going running. We need this actually first. Then we get all of this in place, and then there's built trust because we have more of an understanding of what our policy says. Our policy is so outdated. That's something we're working on, which is why I asked for an agenda item for more people on this council to be on the committees that they would like to be on, because there needs to be more partaking from the council to give the guidance, and the investment policy is really the Bible of the investment portion, right? Telling you where we're going to go. So that's a relevant conversation, but that's a distraction from the conversation I'm trying to have today, that we really need to not just look at it, we need to start being more active about it, because yes, ESG has been talked about for 20 years, but do we have data that shows how much of our full funds are really in ESG? I don't know. I know you guys have an ESG policy, but I don't know anything other than that. What I do know is that other states have, a certain format of how they determine when people start emailing all of you, whether they belong in the bucket, and if they do, then the analysis of them being in that bucket is done. And I don't see that either. So I need more of a process that's happening internally, that everyone's on the same page, so whatever this council is determining at this level, the staff feels comfortable implementing it at this level.
And I think your point is well taken, Mr. Smith, that like if we're going to be asking staff to maybe even add another dimension to their analysis, we have to ensure that like they are fairly compensated, that they are fully staffed. I think that your point is well taken. I think these two conversations actually complement each other. I do, because I think at a staff level, if we are, if this council, the majority of this council decides, hey, we want to put in a DEI policy, then our staff needs to be prepared to take that on. And I think at this point, we're not there yet because of compensation issues, because of vacancy issues. So I do agree. And I don't know if, those conversations can play into our strategy session, but I'm definitely hearing from the treasurer, and I agree with her, that needs to be looked at. So I don't know if anyone else has anything on this.
Yes, so Madam Chair and Treasurer, I would like RVK to come back to us with a presentation on what the diversity looks like for our fund managers.
Just to establish a baseline.
Establish baseline. What diversity looks like for the universe of fund managers out there, and then also whatever data that RVK can find to show what the performance looks like. Because I think that would be very helpful for us as staff and you as council to see. Also, I would just briefly mention that a proposed framework from staff to the governance committee to consider recommending to the council for a process that the staff would go through in reviewing every investment does list DEI as one of the considerations that we would go through every time when evaluating a potential investment. So that is currently in the staff proposed framework to the governance committee.
Hold on, let's make sure. Okay, Superintendent.
And Madam Chair, on that list, if we might look into what other states are doing with their sort of criteria that they use on, you mentioned some legislative, maybe statutory mandates that you have to go before certain legislators. That would be very interesting to kind of pull together so that we know what others are doing in this space, because I think it is a very important thing that we need to look at, especially as we're, from what I understand, our governance committee is looking at kind of, we're taking a very holistic approach at our investment policy, and I think it's really time to do that. What I would want to avoid is piecemealing that policy together, just kind of taking here, there, Band-Aid here, duct tape there. And so I really do think we need to spend some time And there is a plan, and I thank John Clark for the leadership on this, putting the strategic planning, effort together this summer so that we can look at those things. But this is critical, and we really need to have a very, very comprehensive look at where we are with that policy, so we can add things like this as the council deems it necessary. So with that, that's all I have.
On the data, Madam Chair. On the data that you're putting together, I apologize. On the data that you're putting together, I think knowing what other states are doing, even just in the private equity, because private equity is newer to government, because I thought all states hide their, or it's confidential on the fees, and other states don't. It's transparent all the way across the board. And it goes before a council or a committee, and all of that is open aired. So I want to learn and understand, why is it confidential in our state and not in theirs, or how does that work? Does it do that in all other states? And then a whole other big bucket that no one probably wants to talk about is the fee structures. How do they present to their councils about the fees on the back end, and also performance? So when we do like a fund up or we go from Fund 8 to Fund 9, did we really evaluate if they met what they said they were going to meet in Fund 8 before we moved on to give them another $150 million in Fund 9? We don't always have that information, so I think finding out what everyone else is doing too, so we don't have to reinvent the wheel, to allow for more transparency, I think that would be helpful.
Madam Chair, thank you. I think both these subjects fit together as you do. I think they're very critical, and the sooner we address them, the better. I'm particularly concerned about the size of the staff, the compensation, and with a growing fund. I mean, in the last 6 months, you've grown 4 or 5%, and that's a lot of money to undertake to manage. And if we don't have the personnel to do it, we're in trouble. We're not doing our job if we don't provide for that funding. And so, the sooner we address it, the better off the funds going to be managed, and the better off we are going to look as fiduciaries. That's fun. So, thank you.
Madam Chair, Treasurer, just touching on one last quick item. Going back to something you said, Madam Treasurer, about revisiting the investment policy, and Member Tejas, you hit on this as well, that we should do this in whole. There's actually going to be a slide coming up in staff presentations I'm going to point out, and I think it's key because it actually shows for the first time a flow chart of essentially everything that goes into the performance of this portfolio. And the council historically has not been involved in quite a few buckets of that flow chart. And I think that's really important for initially the governance committee, but really the council as a whole to take on how much time do you want to spend on some of these individual items. Because I personally feel like the council's valuable and limited time is probably well spent looking at some items that it has not spent looking at in the past. So I'll point out that flow chart when we get to it.
All right, so without further ado, we move to staff presentation. All right, great, thank you. Thank you guys for the conversation. We're going to go to agenda item 2D, inflows and pacing update with Ms. Iglesias and Mr. Fernando.
Good morning, everyone. So I am going to be starting on, I'm Dawn Iglesias, by the way, one of our investment strategists, and joined by Nino Carpino, who is also a strategist with us. And we are going to be starting on page 55, and straight up we have the flow chart that we've been discussing. And basically we're going to go through inflows and pacing. And what we have here on this page is we've included a flow chart that we thought would be especially helpful for our new members. And so if you have your laptops with you, I genuinely encourage you to follow along with this chart so you can be able to see it. But we thought it would be helpful for our new members to really understand what it is that we're presenting to you, the inflows and the pacing models, how it fits into the broader scheme of the decision-making process. Now, this is despite it looking complex, it's actually a really simplified view of things. At any given point on any given box here, you can add additional lines, additional inputs, take things multidirectionally, but this is really just a 10,000-foot view, because we want to show you not just the puzzle piece today, the puzzle piece being inflows and pacing, but also how those pieces fit into the broader scheme of the picture that we made. So I'm going to take a couple minutes to walk us through this chart so you can see what it is as this process flows. And every fund that we start with, every fund we manage, starts at this top left with the goals and the purpose of the fund. And so in our case, those goals and purposes are typically designated through legislation or through legislative context. And it's these goals that help us as staff and the council in general to understand the various risk-return profiles of our funds. And that then informs, you'll see on the chart, the strategic asset allocation. And so those are the long-term targets that we set for each asset class. Now, in addition to the goals and the purpose of the fund informing that SAA, we also have the capital market assumptions, and those are developed by RBK, and you'll actually see a presentation on those capital market assumptions, I think, next month. And those are the expected returns by asset class. So that's what lets us figure out, in terms of the mean variance optimization, when we develop that strategic asset allocation, what's the expected return for the portfolio overall, and we can develop that in context with the goals and the purpose of the fund, so we can make sure that we're meeting the beneficiaries' needs for why they've developed that fund and what their goals are. So together, it's the capital market assumptions and the strategic asset allocation that then flow into the long-term expected compound return by fund, and that's what helps inform our total asset growth. So when we take all of our funds together, and we want to look at the total growth of the NAV for assets that we have under management, it's going to be informed by what's our strategic asset allocation and how do we expect those asset classes to perform over time. But that's not the only input into our long-term asset growth. It's also the distributions to the beneficiaries. That's based on the spending policies for each of our funds. So those are going to be the funds that come out. And then it also depends on what goes in, and that's the inflows into the funds. Now, in our case, most of our inflows into the funds are either oil and gas revenues or appropriations directly from the legislature. But that's what also drives fund growth in addition to the returns we have on our assets, and together those are going to give us the growth in the NAV. And that NAV growth is ultimately what informs our pacing. And so pacing, when we're talking about it in this context, is just the annual commitments that we make to our private asset classes. And it's that pacing that's going to determine, A, how long is it going to take us to achieve our long-term targets, the ones we set in our strategic asset allocation. And it's also going to help inform, what our actual asset allocation is, because how quickly we can pace into our target asset allocation determines now what are we sitting at today, including how much cash we have on hand. Now, it's those things, the time it's going to take us to get to that long-term target and where we actually sit today, they help inform our interim asset allocation targets and our benchmarks. So when you see those things come before you, it's all these things before that are affecting that and that have an impact on why those interim targets are set at certain levels, and then how we need to adjust our benchmarks accordingly. And that's also what contributes to the actual performance that you're going to see, or that you have seen in our performance reports. Now, of course, I don't want to negate the impact of manager selection. You also see that here on the chart. So in our strategic asset allocation, if you look at the bottom part of the chart, that's then going to determine how our asset class directors are going to structure their asset classes. And you'll see structure studies from them on how their asset classes are going to be structured, and that helps inform the portfolio building, manager search, and all the due diligence process that they go into, and that informs our manager selection and then also contributes to our actual performance. And then at the end of the day, of course, it's that actual performance that's going to drive all the way back around to the front, what's our distribution to our beneficiaries? Because that's why we're all here. And so we really wanted to make sure that what we're going to review with you today, it's these charts it's the boxes in the light blue here on the chart. So all of these pieces that go into inflows and pacing. So this is what we're going to discuss with you. But here's really how it fits into the broader scheme of things. And so we just wanted to make sure, and I think mine and Nina's goal at the end of this presentation is that you come away not only with a solid understanding of our inflows and our pacing models and how we determine them, because we want you to have a good level of comfort of what it is that we're presenting to you, but we also want you to see how it fits into the bigger scheme of things.
And Madam Chair and council members, I can't stress how important this pacing model is to what we do as staff, but also how critical it is to both the interim and 3-year asset allocation targets. I know that Nino's going to be diving into a lot of data, a lot of charts, but it is very important information, both for us internally, but also for all of you to understand why, why we are at our current asset allocation levels, why we've set the interim asset allocations as we have, and how this impacts your setting of the long-term asset allocation.
Madam Chair, if I could add to that just one piece. I don't know of another fund that has a pacing model like we do that's managed internally. So typically a fund they've got, say, real estate, private equity investments, they'll use the pacing model from the real estate consultant and the pacing model from the private equity consultant. It's not all one, contiguous model. So that it's been developed in-house by Nino. We've tested it 1,000 times, probably, Nino, against every other pacing model we can come up with. So it's really a feather in the cap of our operation to have that internally and have Nino running it.
I'm sure, one question. Is this used for every fund that we use to invest? So the permanent funds, and water trust fund, and early childhood is the same?
It's used for each private asset class.
The pacing model. The pacing model is used for each private asset class, and that is for every fund that's invested in a private asset class. Mm-hmm. Our inflow estimates are used for every fund that we have under management. So if there is, and I'm actually going to go through how we look at those inflows, but if it has oil and gas revenues, we're going to estimate what those oil and gas revenue inflows are, and if there's legislative appropriations, we're going to track what those appropriations are.
Perfect.
And Dawn's work and her projections are a main input into the.
Correct. Thank you.
Madam Chair, but on the target allocation, is the standard in the industry to review it every 3 months, 6 months, when you're trying to get to your asset allocation percentage and you need to do interim? What is the standard?
So the question is, what's the standard for review for interims or the standard for review for long-term?
Interim.
I don't know that there's actually a set industry standard. It's really up to it's really specific and unique to the investors themselves or to the allocators. I have seen them be anywhere from reviewing interims monthly to quarterly to annually. It depends on how long and how often you set your long-term target allocations, and then where you are versus where you want to get, because that will dictate how much change you need in between those areas. So I wouldn't necessarily say, and if anyone can correct me if I'm wrong, but that there's a specific industry standard. It's really investor unique. So now I'm going to flip forward to page 57 of your diligent book. And this is looking specifically at the funds that receive oil and gas revenues directly. So this is only the funds that are receiving those consistent oil and gas inflows. Of course, we have the Land Grant Permanent Fund that receives the royalties from mineral production on state land. There's a whole host of minerals that are produced on state lands, but as the Commissioner will tell you, oil and gas makes up about 99% of the contributions from that mineral production into the Land Grant Fund specifically. And then for the Severance Tax Fund, there's a slew of different things that are here, and this is actually relatively new because historically the Severance Tax Fund had only received a portion of revenues that were not used from the bonding fund. Right now, that portion is at about 14%, and it's just whatever isn't used for bonding capacity. We get a transfer twice a year. That's in June and in December. Now, recently, the legislature also introduced some statutory minimums of the amount that has to come from the bonding fund, and that $24 million, that amount will go through 2028, and an additional $92 million per year through 2033. So right now, that's about $116 million combined, and those will phase out based on these timeframes.
And that was, oh, no. Never mind.
These were each different bills, and they had to do specifically with the legislature using general fund dollars to general fund dollars to pay for capital outlay projects instead of bonding in the bonding fund. So it's less additional revenue in the bonding fund, and this is basically the amount of debt service that would have been paid on those bonds had they decided to issue long-term debt, but instead they're making payments to the severance tax fund. The next one is the excess oil and gas revenues. This is brand new. We actually haven't seen a distribution from this yet. It will start next year in FY25. And essentially what it does is cap the amount of school tax and federal royalty payments that the general fund can get, and then it will send those amounts that used to go to the general fund to the severance tax fund instead, so a way of investing those windfall dollars in the near term and putting them in the severance tax fund to redistribute back in the long term. And then there was also a one-time appropriation last year in 2023 of $475 million. Now, the tax stabilization reserve used to have two ways to get funds, and now it only has one. One of those ways is the excess above the 5-year average of the school tax revenue. It either goes into the early childhood fund or into the tax stabilization reserve, depending on the level of reserve. It has received a little bit of money from this inflow source early on, actually before we began to manage these funds. So in 2017 and 2018, it received some distributions from that. But since then, general fund reserves have been over 25%, so that's been going into the early childhood fund rather than the tax stabilization reserve. Now, the biggest source of money that the TSR has gotten over the last several years has come from the excess above the cap of the general fund operating reserve, and that provision was recently removed in this last legislative session. So the excess above those caps will now go into a new government stabilization fund that the legislature created. So it's important for us in terms of the tax stabilization reserve and its potential growth that its biggest source of inflows that it's seen over the last several years is no longer available, and that its only potential for any additional inflows is now if general fund reserves overall are below 25%. So it would take a big drawdown from the TSR itself in order for it to get new revenues in the future, since the TSR makes up such a large portion of the general fund reserve bucket. The early childhood fund receives excess above the 5-year average for both school tax, again, above 25% reserve, and then it receives excess above the 5-year average for any federal royalties on federal land. And those inflows have been really significant over the last few years, and we have some charts here on that. And then there's a brand new fund that the legislature just created, and it will be under our management. This is the Capital Development and Reserve Fund. So it's being seeded with a one-time transfer from excess revenue in the bonding fund, specifically this year. So they're going to sweep the bonding fund for up to $500 million, use that to seed this new capital development fund, and it will be managed, of course, separately from the severance tax fund. It has a mechanism for receiving continual inflows from the bonding fund. The bonding fund is a little complicated, as I'm sure Secretary Frost will vouch for, but more or less, the way that they are capping debt service ratios for the bonding fund, it doesn't affect the statutory distributions between what's available for debt capacity and what's available for transfer to the severance tax fund. So the severance tax fund should still get its portion, and then of the remaining amount that's available for debt capacity, they're saying, we want to make sure our debt service ratios are within certain limits, and so any available money that would be in those debt service capacity, but they're capping the limits of their debt service ratios, that excess would go into this capital fund. We don't have a real clear picture right now on what those dollar amounts would be. I think Board of Finance estimated it would be around 31 million, potentially compounding, but of course that will always depend on just what's the actual revenue in the bonding fund that year. Next page is all the other funds and how they receive revenues. The opioid fund and the tobacco fund are the only two funds that have continuing sources of inflows that are not oil and gas, or just continuing sources of inflows in general on this page. And they receive settlement revenues from their master settlement agreements. But other than that, every other fund that we manage requires legislative appropriations. And so for those, we don't really know if and how much those funds will get any inflows, because it really just depends on the legislative budget that year and their priorities. But we did get several significant contributions this year. The Water Trust Fund will receive $50 million this calendar year. The Royal Libraries Fund will receive $2.5 million, and the Conservation Fund will receive $300 million. These were new appropriations in the legislative session. Here listed is also two new funds that we'll be managing that were designated to us in the legislative session. One is the Higher Education Trust Fund. That one is actually going to be seeded with a transfer from the Tax Stabilization Reserve. So near the end of this fiscal year, we'll see a $959 million withdrawal from the Tax Stabilization Reserve. It will then be moved into this newly created Higher Education Trust Fund that we will manage. And as of right now, I'm not aware of any additional appropriations. There's no statutory continuation of inflow, so at the moment, it's just that single dollar amount that we'll be managing and distributing according to its spending policy. Another new fund is the Workforce Development and Apprenticeship Trust Fund, and that was seeded with a one-time $30 million appropriation from the legislature. And again, at the moment, that's the only appropriation we know of. It does not have a continuing source of inflow.
Madam Chair, I love these two papers. It makes it so much more simplified.
Yes.
Thank you so much.
Thank you.
On that workforce development and apprenticeship, I think this is a perfect example of the idea that we need to start talking more to legislative council services and others about what SIC does versus what the Treasurer's Office does. And when I say that, we've had a couple of discussions throughout the last couple of months prior to legislative session. I don't know if you all remember, where we said when they're writing bills, it's important to know whether or not the money should go to SIC or it should go to STO. And this is one of those examples because it's only $30 million, and they're taking out, I think, $5 million every year, 2.5 splits, and that's not really something. I don't know how to say it nicely, but the SIC is like the bigger picture with a lot more money. They can do a lot more risk. They can do a lot more with it. With $30 million, you can't do that with it. It's I don't want to call it chump change in comparison, but when you're managing $58 billion, $30 million is like, all right, what do we do with this? And in my office, it's more short term. It makes more sense. So this particular bill, it sent it to the SIC with consultation from the state treasurer. We've talked about it. We knew it probably should have just gone to STO, but it didn't, so SIC is going to manage it. But something like that takes a lot of time from staff for $30 million to do the whole asset allocation and all the other things that need to be done when it needs to actually be transferred out every single year. So that's something for next legislative session. I really want us to be working as a team to make sure that when they make these new funds, I think there needs to be an understanding of what a fund is, because the idea of a fund is that it's long-term and that it's going to be sustainable for a long period of time. Me, $30 million doesn't account. And you can invest in part of that account, but it's very, very short-term. So there's something to factor in.
Madam Treasurer, to your point, we actually have a meeting coming up with Legislative Council Service that Annie has helped coordinate for us, where we're going to be talking about drafting bills for us to manage. It's not just about, although this is important, what belongs at SIC versus what might belong at STO, but also in creating spending policies. There's a lot of variation in the spending policies, and some may or may not make sense for the goals of the fund that they actually have available, or they'll include certain language that was appropriate for one fund because that fund works that way and was necessary for that fund, but when the bill is drafted for another fund, it just is copied straight over, and it may or may not function well for this new fund and its purposes. So we are hoping to, we'll be having a meeting, and we're hoping to get some clarity or to give some clarity to council service. Not, of course, not telling legislators or the council service what to do, but to say just in terms of good fund management and structuring the fund and meeting their goals, we want to make sure that these are set up for success. And in some cases, we can point to specific instances where they weren't set up for success and subsequently needed to be changed or probably still need to be changed. And so we want to address that issue that you're raising specifically.
I'm so thankful to hear that. I think functionality and operations for the people who actually have to do the work is so important for people to think about when they're looking at this. And a lot of times it's a copy-paste from one fund to another, and they have totally different objectives and responsibilities. And then a lot of times we don't get the analysis to analyze it, and then when we do, it's within 24 hours. And sometimes we're like, well, what is this fund trying to do? Like, what's the purpose? And so I really appreciate that you all are doing that. We should probably do the same. Let them know we feel the same as far as that concept. And then when we're looking at this, there's 14 of them here, but I know that you also help out other entities like retiree healthcare and all of those. Where are those within?
So within the context of this, we're not including third-party clients. So everything that I'm showing you today is excluding third-party clients, and that's because although we're managing the funds on behalf of those clients, these aren't the funds under our management. We don't dictate their asset allocation.
Sure.
We don't dictate their pacing or the way that they invest. They just invest with us. They tell us how they would like to put money into different pools. So this is really focusing on just what's under our management or directly under our control.
Sure. Madam Chair, the only thing I would say is I completely understand that, but if we can have a page that looks like this of what is outside of us, I think that would be helpful for us to see what the full picture is, even though that one is separate from what we actually control on the asset allocation. Because I think it is important for the council to know, like, did you know we invested through retiree healthcare? We help them. Or at Mortgage Finance, we help them too. Los Alamos County, they help them too. So I think just having that little cheat sheet list like this one, I really appreciate this cheat sheet. It makes it easier than going through each one of the papers that you guys put in and say, okay, yeah, I forgot, we need to look at the rural library. So
I think that it's important on that, sorry for interrupting, but the third party, they're using your approval,
yeah,
but you cannot help them with their asset allocation.
right,
Self-directed.
yeah.
So Charlie will say, you need to talk to someone.
No, that's true, but what I'm saying is just listing them.
Oh, yeah.
Because what's important for us as council, because we talk to a lot of people that staff doesn't talk to, when we're trying to validate and verify salaries or more employees for FIC, it's important that we know not only what we control on our side, but what FIC is also contributing to our communities on the other side. And it is important because you're helping allow for diversification within that portion of the pools on their end, and I'm on those boards. So I do pay attention to what FIC is doing on that end, and I'm trying to make sure that somehow they're still tied in with one another in a thoughtful way. But I think for this council, it's important for us to know how we're contributing, how FIC is contributing outside of what we do.
I completely agree. I just, want to make this point about I promise you the next iteration of this in the future, we'll have that as an addition. So, moving on, slide 59, page 59 of your diligence book, slide 6 of the presentation. So this is just a single snapshot, the summary of all of our oil and gas revenues and other inflows. So this is the snapshot of inflows we've received over the last 20 years and what's expected for the next 25 years or so. Now, the thing that really jumps out on this chart that you will likely notice very immediately is how the last 2 years and the forward-looking expectation is starkly different than anything that we have seen in the past. So in the last 2 full calendar years alone, we have received $14 billion. And for this next calendar year, the one we're in, 2024, we're expecting another $6.5 billion. And then as you look at the forward-looking outlook, this is of course based on our base case scenario. That forward-looking outlook shows that inflows could be over $4 billion in the next several years, and then even for the next long term, significantly higher than anything we've seen in the past. Those prior averages, if you look at 2018 and before, were less than $500 million. So vastly different in the types of cash that were coming into the fund. And as you saw in that flow chart, these inflows significantly impact everything else that we're looking at and all of the decisions that you need to be, or that you are making. One of the themes that you will see in any presentation that I give you about inflows is that theme of uncertainty. I want to always iterate that these are estimates. We use them for our planning purposes, so we can have an estimate of our fund growth, have an estimate for pacing, so that we can plan appropriately. But no one really knows what the future holds, and that's why we also engage in scenario planning, so we can look at a variety of ranges of how things could be different from this base case, and then if things are different, how would that affect our plans, and that's what we're going to show you today. So one of the things you might be asking and looking at this chart is, how do we derive the base case at all? And so looking at these, because we can't predict legislative appropriations, that depends on things that we're not able to forecast, really. We look at the statutory formulas for oil and gas inflows, and that's the biggest significant driver of our inflows anyway. And so that's what we look at to derive our forward-looking base case. And those oil and gas estimates are going to always depend on 4 things. It's first, how much of the commodity is produced. Second, where is it produced? Is it on state land or is it on federal land? Because that affects what fund it goes to. Third is the price of that commodity. And then fourth is the statutory formula for how our funds receive those revenues. So if you look at that big spike in 2022, it wasn't just because of a massive price spike, which by far was the biggest cause of the spikes in revenues of state receipts overall. But it was a spike in revenues for these funds because of their statutory formulas. Because, say, the early childhood gets money over a 5-year average, when you have a significant 1-year spike at the tail end of that 5 years, you're going to have a lot of revenue over that prior 5-year average. So that formula is also driving what those funds get. And we're specifically looking at all of these components when we build these base cases for you, so that we're looking not just at how much oil and gas do we think is going to be produced, what do we think is a forward-looking price for that, but also how does every single fund we manage actually get a dollar of oil and gas revenue. So then that takes us to the next page, where we're looking specifically at that first component of production. And this is getting into the weeds. I am getting into the details with you here, but I want to build a comfort level with you all on how we estimate this, the things that we are uncertain about, and the things that we try to do to manage and mitigate that uncertainty. And so the first thing that stands out here is the Permian Delaware, which is what New Mexico's portion of the Permian is sitting in. We're in the Permian Delaware Basin, that's separate from the Permian Midland Basin, which is exclusively in Texas. But the Permian Delaware has the most profitable wells in the country. If you look at the chart on the bottom left-hand side here, these are break-even prices for comparable shale oil plays, and you'll see that the Permian Delaware has the lowest. And if you look on the chart on the bottom right, you'll see here that Permian activity in general far surpasses that of any other North American oil play, and that actually activity in the Permian Delaware specifically recently surpassed that of Midland, at least last year. And what this tells us is, if we have low break-even prices, it means that we can produce oil and gas in the state profitably. New wells can be drilled at relatively low prices. That puts us at a competitive advantage versus other places in the country. The second thing is that it's those favorable economics economics of how, our wells are drilled and their profitability that's expected to drive our near-term production growth. So when you see production growth in our base case scenarios, this is the factor that's fundamentally underlying it. Why do we think production will grow here? Because we have such great economics in the Permian Delaware. So then that leads us to the question of how long then would production keep growing? And that we can see a glimpse of on the next page. And this is our production outlook in the Permian. And one of the things that should stand out here, the chart on the left at the bottom, is that even though we expect production to grow over the next several years, our base case does incorporate a peak. That peak could occur somewhere in the late 2020s to early 2030s. And while some of that is due to expectations for global oil demand, energy transition, et cetera, what that peak is actually mostly due to is the economics and our current understanding of the maturity of a shale oil basin. And so if we're thinking about horizontal production, New Mexico's on a treadmill. You've probably heard this before. In order to grow production, you have to keep drilling more and more wells, because every well that you drill, this chart on the middle here shows you there's a natural decline rate. Production's going to spike and then it's going to drop off very quickly. So you have to keep drilling more new wells in order to offset that natural decline. And we've been drilling quite a bit the last few years, and so production has shot up very quickly. But that expectation is, you can see the chart bottom left, is that over time, fewer wells are drilled, and then those fewer wells that are drilled are no longer able to offset the production that's currently in place, and so eventually you start to see a steady state decline. Now, Rystad Energy estimates that just based on the economics and the shale that's in the rock itself, or the oil that's in the shale rock itself, that there's probably 10 to 15 years of drilling at pace left in the Permian Delaware part of the basin, and that's just if nothing else mattered, you could just continue drilling out pace. So beyond that, then, is where things like global demand, et cetera, come into play. But even absent that, there is expected to be a peak at some point in the Permian Basin, the same way that we've seen a peak in every other shale oil play in the country that has previously seen a lot of growth. On the next page, we actually see another factor playing out here on page 62, and this is consolidation in the Permian Basin. You have likely seen a lot of really big headlines recently, things like Occidental acquiring Crown Rock and ExxonMobil acquiring Pioneer. These are really huge deals that have received a lot of attention lately. And while most of those deals have actually been more specific to the Texas side of the Permian Basin and more focused on the Midland Basin, the Permian Delaware has actually seen a lot of merger and acquisition activity as well. You can see that here on the chart, and we actually listed some of the significant deals that have happened recently in this blue box here on the left, or on the right. And what this tells us is a few things about the outlook. You know, first of all, it tells us that public producers are willing to pay a lot of money in order to secure a more long-term presence in the Permian. To build out,
Can you repeat that?
public producers are willing to pay a lot of money. If you look at the size of these deals that are here on the chart, they're significant. So they're willing to pay for inventory and a long-term presence in the Permian Basin. This signals that they're situating themselves for that long-term presence. What it also tells us, though, is that that public producers tend to be more capital disciplined. They're focused on steady business operations, steady state growth, and stability. So we're unlikely to see, as more and more consolidation happens in the Permian, the types of huge spikes in production that we've seen over the last few years, growth of almost 40% a year, 50% a year, these massive, massive year-over-year production growth. We're unlikely to see it continuing at that pace as the basin consolidates more. You're likely to see more stable, shorter growth, which is actually consistent with what we have in our base case scenarios of, less than 10%, sub 5% growth year over year, because you're going to have more and more companies that are more capital disciplined trying to build that out at a steady state rather than running up production like we've seen the last few years. And so then sticking with production, on the next slide, page 63 of your diligent book. So then how does the energy transition fit into this whole scheme? And one of the things that we're paying attention to is that even once demand starts declining in the future, oil is still going to play a part in some way in the global energy mix. Now, the significance of the role it will play still remains to be seen, but it will play a role. You know, we're not going to see, oil and gas demand just vanish overnight. Now, if you look at projections for what that demand might look like in the future, you see here this chart on the bottom right-hand side, they are all over the place. This pulls in projections from a large number of places, and you can see there is absolutely no consistency of thought of when production will peak or how fast it will decline. The only consistency you'll see here is that most of them do expect that peak to occur sometime in the next decade, and that it will probably decline thereafter. But other than that, it's really anybody's guess. And then compounding on that, we have an example of the types of unknowns that are embedded in this on the next slide. So this is an excerpt from J.P. Morgan's latest annual energy paper. And it shows what fossil fuel consumption, electricity generation, and wind and solar generation over the last 30 years or so have looked like, and then where it needs to get to in order to fully realize the energy transition goals. Now, you'll notice that there is no end date on any of these charts. It's because J.P. Morgan admits very keenly they have no idea how long it will take to get there, but it is how far have to go in order to fully realize the scale of the energy transition goals. And so what we focus on is, rather than trying to pinpoint right now what nobody else reasonably knows, instead we can look at how different assumptions affect the future outlook, and then we can use those assumptions to build scenarios around what that outlook could look like and how that differs from what our current base case expectation is. And we start to see some of that on the next page, page 65. So these are Rystad Energy's scenarios for oil demand through 2050. This comes from their energy transition risk analysis. And the way they built this out, it's basically a concept that looks at different scenarios that limit global emissions so that warming doesn't rise beyond a certain degree, and then backs into, in order to meet the assumptions to get to those global mean temperatures, these are the types of things that you would need to see. And then again, backs into that, okay, if these are the assumptions that are met, here's how it would affect demand, here's how that demand would affect prices, and how prices would then affect production. So it's a backwards-looking way into saying, what could production look like under these different energy transitions? And you'll notice here, just looking at the three different scenarios, they make a bunch of different assumptions around things like EV adoption, plastic recycling, and other uses in transportation and stationary sectors. So how far you can get along those goals, what kind of demand in regular or normal fossil fuels would you need in, to meet those different goals, and then what would production look like? And specifically, when we look at their energy transition scenarios, they don't do just a full-blown forecast just for New Mexico, but they do drill down far enough to say expectations under these different scenarios, specifically for U.S. shale and tight oil plays. Because their economics are different, they are modeled out differently in these energy transition scenarios. So we use those estimates rather than just U.S. production outlooks overall, sort of extrapolate what New Mexico could look like under these scenarios. And that's going to be on the next page. So this chart's a little busy. I'm going to walk us through a few pieces of it, because we can actually learn several important things just from looking at this chart. So the first one, all of your dotted lines on the chart is New Mexico production under different price scenarios. So this is Rystad Energy's forecast that says, if nothing else mattered other than price alone, and then the economics of the basin, what would production look like? And so you see that along all these dotted lines for anywhere between $30 WTI and $100 WTI. The next thing it looks at, your solid lines, are the energy transition scenarios that are now extrapolated to New Mexico, and you can see how they plot against the different price scenarios. And then the blue line with the yellow dots, that's Rystad's just base case projection for New Mexico specifically. And so this chart tells us a lot of things. First of all, in every scenario, short-term growth is expected. So we are more likely, even in a high energy transition scenario, to see production growth in the next year or two. Now, once you start getting beyond that, you see a lot of differences in how long growth is expected to continue. But near term, it's still expected. The next thing that really jumps out about this chart is that production peaks anywhere in the next 5 to 15 years, regardless of the scenario, regardless of the price scenario or regardless of the energy transition scenario. That's reflective of the maturity of a shale basin and less so to do with the energy transition. Now, the timing of that peak can vary with these different energy transition scenarios and price scenarios. But the peak doesn't change across those expectations. The next thing that very simply jumps out from this is there's a very wide range of outcomes. The top and the bottom are very different from each other. So we have a base case scenario, that's what we plan on, but we track this constantly and regularly, and we're always looking at what tells us for next year, how has that expectation changed? How has the path changed? Because at the end of the day, there's a huge range of things that it could be in between. And so our way of staying on top of that is being aware of that range and then adjusting constantly as those expectations. Now, the third thing that I don't know that will jump out to you, but certainly jumped out to me, and I think it's a good point of, or a good thing to point out in this, is that Rystad recently developed a new methodology in their base case versus their energy transition scenario. So in the past, they had always linked their base case, what they call their U-cube forecast, to their mean energy transition scenario. The two were tied to each other. That's no longer the case. This last year, they untethered those because the prices that they were seeing actually occurring now no longer fit the expectation of that mean energy transition scenario. Now, this is something that we're actually planning on following up with them on, getting more detail about this untethering of those two scenarios, what it says about their expectations. But I did want to point that out to you all. If you ever want Rystad to present to you, this would be a good topic of discussion for them to get more understanding for why they no longer link those two together. On the next page, you're looking at the price outlook. There's a lot going on this chart. I'm not going to go over all the pieces of it. The point of this chart, you can see in the variety of the lines here. The point is that the biggest single source of inflow volatility that we see is prices. Yes, there's a lot of uncertainty in production, but when production moves by a few million barrels, it's not going to move as much as if price moves a few dollars. And so this is our single biggest source of volatility.
And the one we have the least control over.
And exactly.
This is $1 equals 40, equation to $1 less on a barrel. We know it. Equals.
For the general fund, it's $1, I think it's almost 40 or so. I actually have, for the land grant fund specifically, $1 change in oil is about a $25 million change in what comes into the land grant fund, whereas a change of 1 million barrels of oil is about a $10 million change. So that differentiation shows you that price is going to matter a lot more on that volatility than the production itself. And The other thing to point out about this chart is that, last year, yes, there was a price spike and prices have come down, particularly for oil, but they are still elevated above the historical averages, and by like $20. So from 2015 to 2020, prices averaged about $50 a barrel. We're sitting on, 80-something today. The forward-looking expectation is anywhere between 65 and 85 on that long term. That's a massive difference from an average $50 oil. And given the outlook, there are more risks now on the upside of oil prices rather than the downside of oil prices, because we haven't had the types of supply glut that were present from 2015 to 2020 that really held those prices down. And the other thing just to note here, when we look at these confidence intervals here on the side, the big point of that is that prices are absolutely notorious for shocks, and they depend on so much more than market fundamentals alone. I mean, all of your price models are going to be based on demand and supply. But real or perceived monetary policy is going to change oil price. Geopolitical tensions is going to change oil price. As we saw with the Russian invasion of Ukraine, it's going to change oil price. And these things are simply things that we cannot foresee happening. And so, yeah, nobody really knows what prices are going to be next month, let alone 10 years from now. So how do we plan? Well, we use an average of these various forecasts within the near term to say, okay, these are the most reasonable expectations by people who are paid very well to forecast this for a living. And we're going to use the average of those expectations in the near term. And then in the long term, we're going to take what I like to call a conservatively realistic view. And so my average that I'm using for our base case scenario is around $62 a barrel. That is a lot lower than the averages that are here on the prices that you see now. And it is, static for that 10-year period, using 62. And the reason I'm using that is all of our production scenarios are plausible at around 62. And one of the feedback that I got in developing this model is we don't want to constantly be chasing prices. We have to plan for pacing 10 years out. If we're constantly chasing prices, we can't go to our ACDs and every single quarter or every single year say pacing has just completely changed on a whim. So we want to look at what price can we very reasonably expect this level of revenue, and a price level that it would take a very significant change in the market dynamics in order to adjust from that. And we take that price on the low side because we can always adjust up. It's very hard to adjust down. Once we've committed in our pacing model, once we've committed to those private assets, we can no longer uncommit to those. So we'd rather have to adjust each time to potentially more revenue, but not so far that our current estimate is so low that it's so unrealistic that it's irrelevant, and that we have so much cash on hand that we haven't even been keeping up with. So again, keep that in mind. I'm looking at the conservatively realistic expectation in this base case. Very quickly, on page 68, so this, the next three slides are looking at land grant, severance tax, and early childhood, specifically, how each of them get revenue. So land grant only gets the, or not only, but it specifically gets royalties from production on state land. And so this is looking at forward-looking. We just take out land grant. Here's our base case for land grant. And I've illustrated here on this chart how price volatility changes that. So you'll notice in the green dotted line and the yellow dotted line, I've changed nothing in the input here other than the price. The production is exactly the same. So remember, my baseline here is around 62. This lower price scenario is 55. The higher price scenario is around 100. And you see a massive range of almost a $2 billion difference in those two sources by changing that price alone. And so really just iterating that all of our estimates here, they're point-in-time estimates. They are indeed estimates subject to a lot of uncertainty, but we deal with that uncertainty by constantly capturing the actuals and readjusting the forward-looking expectations. The next page for severance tax. Now, this is looking at the new mechanism of distributing school tax and federal royalty revenue, so you can kind of see a picture of how that works. The blue bars are the amount of school tax and federal royalty revenue that goes specifically to the general fund. The green bars are the amounts above the 5-year average. That isn't different. Under this mechanism, the amount above the 5-year average still goes to early childhood, mostly, or potential for some of it to go to the tax stabilization reserve. But you see that now that the general fund is capped at a certain level, the yellow bars is the difference in between. Those are the inflows into the severance tax fund, and then on the chart on the right, you can see them stacked up against those historicals. Very, very stark difference there. It's what we've been calling a potential game changer for the severance tax fund, and it makes a very big difference because it's now these revenues on top of what used to be our single biggest source of revenue, which was the royalties from the land office. And now, comparable in size is these distributions from school tax and federal royalties, of course, depending on price and production. The next page, real quick, early childhood, it shows how the estimates above the 5-year average work. One of the things that you'll notice in our forward-looking expectation is that the inflows into that fund will decline over the next few years, and you see that because the 5-year average gets bigger and bigger, so the amount above the average gets smaller, and eventually you no longer have an amount above that average. So absent a very significant spike or a complete change in the dynamics of the basin, we're unlikely to see any additional revenues into that fund after the next few years. But the revenues that we'll be getting still in the next few years are still pretty sizable. 2024, we're still looking at a total of over $2.5 billion. If you'll notice here, there's no light blue chart in the 2023. That was a timing mechanism. The amount for the school tax, we expected to hit in the end of December. That's usually when it's transferred. It actually came in January, so that amount got pulled into the January, into the 2024.
And the reason there's no yellow is because that doesn't kick in until...
There's no yellow on this chart because this is just early childhood.
Oh, I'm sorry, never mind, I was on a previous.
And yet there's no yellow currently because, yes, that does not, for severance tax on the previous chart, that doesn't kick in until next year. Okay, so now we're rolling all of this up, page 71, in just looking at specifically the oil and gas revenues. This is not right now looking at legislative appropriations, but what's that forward-looking expectation over the next 20 or so years? Our base case is the blue line with the yellow dots, and it's stacked up against the energy transition scenarios and Rystad's own base case, so you can see where our expectation is relative to all those other differences. So the key things to point out about...
I'm sorry to interrupt, but going back to the early childhood, so currently there's $6 billion in there, and then I'm reading here that over the next 3 years, we're gonna add an additional 4. We're looking at $10 billion in early childhood.
I think we're already at 8, so I just looked at the paperwork.
We're
at 8, because I think there's $2 billion in cash.
Once you account, I'm not sure if that was from here, and if it's from here, I apologize, but,
Yeah, it's on page 70.
Okay. Yeah, it received over $5 billion the last 2 years, but, yes, we're really high on the current, I have to look at the performance chart.
6.8 in early childhood with 1.9 in cash.
The 1.9.
Because that cash was what came in January.
So $8 billion, another 4 in projected additional revenue, $12 billion.
We transferred
That is
1.149
incredible.
in January
That's
from the
incredible.
treasurer's office. And then the 1,018,000 is what the economists are projecting for August.
So yes, around $12 billion for a fund that started at at $300 million in 2020.
That's correct. And so how do you pace around you know, the uncertainty around the legislature on what they might do with maybe pulling money out of there, that sort of thing? I know you have to be conservative, but, you know, what would you do there?
Carefully.
That's honestly a very fantastic question, and you'll notice there's a qualifier on every chart that I have here that says assumes no statutory changes.
Right.
At the moment, you know, the practice that I've been taking in this, you know, base analysis is a similar practice to what the consensus estimating group has for the general fund, which is you forecast current law. You don't forecast what the legislature is going to do. Now, we can try and plan around that, but I don't include it in any base case. But it's definitely something to be aware of, and I'm glad you bring it up because it is something for this board to be aware of. When we set asset allocations, when we allocate to private assets, for anything that is a statutory fund, that means there's no constitutional amendment required to withdraw from that fund. Any statutory fund can be statutorily changed. And it can be done so within a single year. And we do, thankfully, have great relationships with our legislative staff counterparts to, you know, make them aware, if this is a thing that you're looking to do, here's a timeline that would make sense. You know, for the tax stabilization reserve is a good example. $959 million that was withdrawn, or that will be withdrawn this year and then deposited into a new fund. It's still a fund we manage. It's a little easier for us than if it were, say, transferred to somewhere else. But that still takes a lot of coordination, timing. Luckily, that fund is structured as such to be able to make those kinds of withdrawals. There aren't a lot of private asset commitments in the tax stabilization reserve, but that's always something for us to keep in mind, is the ability for those statutes to change. And so only the land grant fund and the severance tax fund and the water fund, thank you, are constitutionally protected. And even then, they can be changed, but it's a much longer process, would give us more time. Anything that's statutory, you know, either can be done in a legislative session for the current fiscal year, the next fiscal year, or in a special session to be done immediately.
Thank you for that.
And Dawn and I work very closely, so if she sees potentially, you know, there's a likelihood of something occurring, she'll come to me
I'll
and
come
ask.
running.
She'll come running. She'll come and say, okay, well, how does this impact pacing? And so we'll plug it into our models, do that scenario analysis, and if it's something that has, you know, a meaningful impact on pacing, then, you know, we'll revise our plan and speak with our APDs about, you know, pivoting a bit. But we haven't come to that point yet, but this is something that, I mean, we probably, how many times do we update the models a year? I mean, we probably go through exercise 6 or 8 times a year.
Yeah, definitely much more than quarterly.
Yeah, going through this, so.
Madam Chair, Ms. Dawn, I have a question. It's not connecting in my head. On page 70, we talked about the early childhood education, but when I look at page 69, and I see the graph to the left, and the green is the early childhood, and it says we're under 4.5. But when I see our paperwork, we have 6.8 in the total fund, just distributed.
Oh.
And then, so that's my first question, and I know it's something simple, but my brain's not figuring it out. And then the second part is, the green is the early childhood, but then I don't see green after 2026. And I think that's connected to what you're saying on page 70, but then I think I just need a little bit help to connect it all.
Yes, actually, I'm glad you pointed that out. I think I'm showing one revenue source and not two, but the title says two. On page 69, where it says the distribution of school tax and federal mineral leasing, I'm showing one and not both, and that's my apologies for that. So that's no, I'm glad you pointed that out, because I very clearly pulled the wrong chart when I was pulling this presentation together. But the 2026 is correct, and that does line up with the next chart. So there's no more green bars after 2026. And so on page 70, there's no more distribution bars after 2026 because that plan, the 5-year average, catches up with the total amount of revenue that's collected. So then after that, there's nothing above the 5-year average.
Okay, so then basically whoever's in charge of what they're doing with the early childhood, they know that after 2026, they basically have to utilize what they have in existence right now.
I know it's presented in every general fund revenue estimate, even though it's not a general fund source. All of the consensus revenue estimates include expectations for early childhood, and I know the analysts at DFA and LFC work with the early childhood department to be aware of what those distributions are.
And then do we know by chance what we distribute out for them each year?
Yes. So this past year, we distributed $150 million. Next year will be $250 million because there was a legislative change to increase the statutory minimum distribution, which is now $250. And then after that, it is 5% of a 3-year average. And I forget the exact timing, but that is expected to get up over $500 million with the size of this fund. So it'll take a few years to get there because, of course, 5% of a 3-year average, but it will get rather large. Okay, so then finally, page 72, for my portion of this, how do these different inflow scenarios affect NAV growth? So if you remember the fund flow chart, or the flow chart that I showed you all at the very beginning, we pull all these pieces together in order to ultimately get to how much do we expect the total funds under management, so again, with that asterisk, excluding third-party assets, how much do we expect total funds under management to grow over the 10-year outlook? And we look for 10 years because 10 years is the forward look of the pacing model. And we are looking at, under the base case scenario, reaching $100 billion by 2032. Currently around $50 billion now. So that is very, very significant growth. And the other thing that stands out about this chart is even under the lowest energy transition scenario that we're modeling from RISE-DAD, growth over the next 10 years could increase to $84 billion by the end of the 10-year outlook. That's still a significant amount of growth. And that range is anywhere from $84 to $130 billion, whether we're looking at the faster energy transition scenario or the lower transition scenario. And each of these have different impacts for pacing and the outlook. And so I'm going to actually end there and turn it over to Lino to discuss those pieces.
Thank you, Dawn. So, as Dawn stated, our pacing models, what they do is provide projection of the annual level of commitment that allows us to achieve or maintain target allocations for those private asset classes. It uses multiple inputs to project contributions, distributions, and net asset values. The inputs are largely based on historical data, but we also do a subjective overlay that incorporates our forward-looking expectations. And as we stated earlier, we update our models with actual information as it's available. One thing I'd like to just make clear with pacing is, the results from the pacing model, it's a guide. And, it's a guide for our private asset classes. It's not static in any way, and it's not something that should be adhered to in any kind of a rigid way. It's fluid, it's flexible, and it's responsive to different types of changes. So given the increased amount of inflows, that's been the main driver behind our increased level of commitment. So what we decided to do is to take that scenario analysis and take it one step further and apply the results to our pacing model, which produced a range of outcomes that you see on page 75 and 76. And I'll start with 75. So 75 shows the private asset classes, in aggregate. The black line is our actual level of commitment historically, and then the dotted lines there is, here's a 5-year look forward, with, you know, the upper and lower bound, indicating a slower or faster energy transition. You can see where our base case is. Now, one thing is, you know, our base case looks substantially similar to the Rystad mean. However, if this, we were to take this analysis out further than 5 years, that's where they start to detract, and materially so. So the average range over this period from, you know, the Rystad Plus to the Rystad Sigma portfolio, we're looking at about, you know, a range of about 1.4 to 2.6 billion. And so an average range, let's say, of $2 billion. So as Don said, as a coin term, conservatively realistic. Yeah, we want to be conservative, but we also want to be realistic. You know, the risks of overcommitting far outweigh the risks of undercommitting. If you overcommit, you end up in a situation where you either have to sell investments or stop investing. And that could lead to vintage year risk and other types of things. Whereas if you undercommit, then you have these excess cash balances. So it's certainly a very delicate balance. But I think with our analysis and the base case that we're using and just taking a look at the other scenarios, you know, we think that the plus sigma, moving towards the plus sigma scenario is far more likely than the negative sigma portfolio. Would you agree?
At this point, yes.
So as I mentioned, the next page just is the same thing, but just broken out by private asset class. And then the following page, I want to drill into our base case scenario. So what we're using in our pacing models, and I want to walk you through that process. In each of the last 2 years, so our commitments have nearly doubled from the prior year. So if you take a look at the chart there on the left, there's our commitment. It's a stacked chart, so you can see all our private asset classes. But if you take a look at, you know, years 2021 through 2023, essentially, year over year, we doubled our commitment. But when you look at the chart on the right, which is our actual contributions, which are, from this perspective, our outflows, so capital calls that are being made that we're meeting. Over that same period of time, it hasn't changed. And the reason for that, there's a couple of reasons for that. But primarily, one of the things that we're noticing in the current market environment is it's a tough fundraising environment. There are a lot of people like us who are on hold. And so funds are having to stay in market longer. They're offering better incentives for early investors, whether it be, you know, preferential terms or increased capacity, things like that, of which we're taking full advantage. But from the time we commit to the time where the fund actually begins investing, that period has increased. And so that's something that we're seeing. We're monitoring it very closely. And if that trend continues, then I think, you know, an adjustment will need to be made into our models to accommodate that.
Mr. Nino?
Oh, sure.
On those two graphs, you see that 2024 to 2028 is really skyrocketed. On the opposite side, it's similar, but then you go all the way down in 2029. What changed in 2029, or what's going to change in 2029 that the shift of the commitment is a lot lower? That's my first question, and then the second one, and then I'll just go there.
Okay. So when we think of pacing, we have a 10-year look forward. Now, currently, based on you know, internal discussions and what Vince is looking to do, given our excess cash balances, is let's shorten the period of time in which we achieve, these target allocations, although, still doing it in a responsible manner. And so what we've done is we have an accelerated time frame of 5 years. Now, I'll go into this a little bit later in a little more detail, but so essentially when you're looking at 2028, we're hitting those target allocations for each of the private asset classes. At that point, we have a decision to make. Do we want to increase them further, or do we just want to maintain them through the 10-year look forward? And so right now, the assumption is we're just going to maintain them. And so that's why you see that drop off. Now, the likelihood is that they're going to get increased. And when they do, then you'll see that the back half of this 10-year look forward will look a lot more like the front part, the front part.
That probably leads to my second question, Madam Chair. When you're looking at 2029 to 2032, you have under 3 in all 4 of those years, but then the contribution is over 4 on one of those years and more than 3 on all of the others. So that tells me we have a negative overall. So we do, and a little further into the presentation, we'll take a look at what our net cash flows are. So taking into account not just outflows and capital calls, but distributions that come in from our investments and how those go. And
go ahead. If you think right now we have a lot of excess cash, so to the extent that we can get the capital calls from all of our prior commitments to outweigh, the new cash that we have coming in, then we can make some drawdowns against the excess cash you have now. So you actually, looking forward, we want to see net negative because that's where the real drawdowns on the extra cash balances are. Because right now, again, sort of like the treadmill concept, it's difficult to keep up. We're making new capital commitments. It's taking them a while within the investment period to actually draw the capital down or to call that capital. So we still have it with us, and then each year we're getting new inflows, more and more oil and gas revenue, and so you're trying to make more and more capital calls. So eventually you're getting to that point where you're net negative and your contributions, the capital calls that you're needing is exceeding the amount of revenue coming in, and that's how you really start to draw down on that cash.
So basically, Madam Chair, this is just one snapshot of one piece of a full pie, and you still have a lot of money to work with, add into the equation for the overall 10 years that will add to the gap that is showing on this end, actually net positive. Okay, thank you, Madam Chair.
The other thing to keep in mind is our private investments are primarily, the vehicle structure is closed-end funds, and so they'll draw down capital over time. And so I think a lot of those last 3 years are based on the lower commitment in prior years. That's why it's so low. So if we turn to page 78, here we're going to take a look at distributions. And when we talk about distributions, we're talking about investment inflows. Those were larger than normal. And that was primarily due to, within our private debt portfolio, we redeemed from several hedge funds. Those were open-ended fund investments, and so, they returned our proceeds according to the fund term. So substantially all of that took place last year. And I think the total dollar amount last year was $1.8 billion. And so that caused, if you look at the chart to the right, that actually caused net cash flows in 2023 to be positive. And that was a one-time event. And then the remaining portion of those redemptions is much smaller. It's just $300 million for 2024, and we've already received half of that. And I'll have an update on kind of our year-to-date cash flow, where we are. So if we go back to the distribution slide, and you take a look at the back half of that 10-year look forward, so we're looking at 2029 2030 to 2033, you can see there that, our distributions increased dramatically as many of our earlier investments reached the end of their fund life. Now, if target allocations aren't increased, then, the distributions will overwhelm the contributions that we're making, which we see here, resulting in what we see in the net cash flow chart. So you look at the chart to the right, and you look at those last 5 years, and you take a look at that, and on a cumulative basis, that's about $13 billion. And so that money would need to go somewhere. And the most likely scenario is meaningful, if not most of it, would go to private asset classes and increase allocation. Would you agree with that, Ben?
Yeah, I think in the long run, well, first, Madam Chair, those last 5 years that Nina was pointing out on the right-hand chart, that's the cash machine, or several months ago. Yeah, I think in the long run, we need to be thinking in terms of, particularly the constitutionally protected funds, grant severance, that it would be about 60% equity. We have the liquidity for that, and that equity could even be divided half and half, private and public, kind of at a maximum. So there's plenty of room still in the private sectors of the market where we get that compounding and get this cash flow machine effect. There's still some room in there that we could raise weights when that cash starts coming in.
And if we took that chart further out, it would just continue to accelerate. Most of the private asset classes, and this is the non-legacy portion, we started allocating to them in 2011. Private debt started in 2012, and so a lot of those funds have reached the end of their fund life. And so they're selling assets and making distributions to us. And so, that's something that's... If we look at the next slide, it shows our cumulative net cash flow. And so essentially, this depicts the J curve. And so what you see is that the path that we were on, if you take a look around 2020, that was kind of where we reached the bottom point, and we're starting to turn up. Then we had, the record inflows and increasing our net fund growth, as well as increasing target allocations for private assets. And so we had to, increase our commitment activity going forward. And so that's why you kind of see this double dip. So rather than, continuing that path kind of upward, you're seeing where we're doing a double dip here, which is very important for us because by remaining deep into the J curve, our capital has the ability to continue compounding.
And Madam Chair, if you look at 2024 on this chart, the cumulative is about $10 billion. It goes to about $17 billion. That cash is already on our balance sheet. That's already locked in. We'll be able to pay for that.
So if we turn to the following page, page 80, here we're looking at net asset value historically and going forward, and the black line there is our target net asset value, essentially being the sum of the target net asset values for all the private asset classes. One thing I wanted to point out is you take a look at 2022 and 2023. So year over year, that net asset value decreased. And there are a few reasons why that occurred. One, performance in the private asset classes was modest. With real estate, they kind of continued that drawdown that they've had. But then the other part that, the other factor that I described earlier, where it's just taking funds longer to put money to work. And in some cases, they're, at least initially, they're choosing to use subscription lines rather than call our capital. And so, essentially, that's why we're seeing kind of that that year-over-year decrease in net asset value. And then if we take into account, you know, the growth of the fund on an allocation basis, you would see that as well. And that's the result of inflows being higher than what we had projected. So as you can see here, 2028, that's our accelerated time frame of 5 years where we achieve those target allocations. And then currently the plan is just to maintain those through the end of the 10-year period, which you see that our plan accomplishes that. And one thing I do want to point out is, and you may recall last year when we presented, we had an accelerated time frame of 5 years. And the years passed and we have an accelerated time frame of 5 years. And the reason being is that year-over-year decrease. I mean, we're already, you know, in terms of pacing and sourcing managers, we're doing all that we can. And, you know, I think the prudent thing for us to do is just to extend it by a year rather than try to make that year up. And so we talked about it internally, and we felt like that was the right path to go. So instead of 2027, our plan have us achieving the target allocations in 2028.
And Madam Chair, when Nino says accelerated pacing, he's correct, he's right, but the acceleration isn't a lot. So we can't pace after we shouldn't pace more than about 7 years. Because we get most of our money back from those closed-end funds by year 7 after we make the investment. So pacing beyond 7 sort of works against ourselves. So shorten it from 7 to 5, but it's not an extreme acceleration.
Yeah, it's not. It may appear so, but that's just because of the growth of the fund. That's a very large, predominantly that's the contributor to, the main contributor to our increased level of commitment. So then, next page, I'm on page 81. I want to just drill in real quickly here to cash flows. So it's great that we put a pacing plan together, and but you know, we need to determine that we have sufficient cash available to meet these capital calls. And so what we do here is we take the net cash flow from investment, and then we combine that with the statutory net inflows, and then that results in an adjusted net cash flow. And the thing that's interesting on this page is, so you take a look at, you know, the first part of the 5-year look forward, and net cash flow from investments are negative. However, that's compensated, you know, by the inflows from the state land office. And then you look in the back half of the 10-year look forward, we have significant net cash inflows from investments, and that offsets, you know, low to negative net inflows. You want to comment about that?
Yes. So for this chart, it really shows how our pacing now and the distributions or the inflows that we expect from our investments will ultimately offset what we expect to be a declining amount from the inflows from oil and gas. And so you'll notice that right around the same time, they flip. We have all of this cash on hand right now on the statutory net inflow. So this is what are we getting in the oil and gas revenues and the inflows into the fund, minus all the distributions that we're making. So what do we have to pay out to beneficiaries versus what we're getting into the fund? Huge differences there on the positive side for us right now. And that's good because that means now in the near term, we have a lot of cash to be able to make these big capital calls. And that by the time our distributions catch up with us, so to speak, because most of our funds are some percentage of some 3 to 5 year average. So eventually we'll have to make bigger and bigger distributions to our beneficiaries, which is exactly what we're here to do. And at that same time, we'll be seeing contributions from oil and gas, at least by all current projections, starting to decline. So eventually our distributions to beneficiaries will overtake our inflows that we're getting into the fund through oil and gas revenues. But when that happens, we'll be getting a large sum of net gains from the investment into the bid price
At
asset
least that's
class.
what's projected.
The current projection, yes.
Based on what our allocation is, based on what our return levels.
Right. So, and one of the things we do in the pacing model is we put the actual fund terms there. Now, future commitments, we don't know we don't know how they're gonna get invested, but as soon as we commit to a manager, we plug them into the system, we review the LPA, we pull out the actual terms. So how long is the investment period? Is there, the possibility of an extension? How long is the fund life? What are the possibilities for, extension? And we plug that into the model. So that, when you start to see those distributions, it kind of follows the fund life, right? Through, kind of the different stages where you have kind of the investment period, and then the harvest period, and then you have kind of the liquidation.
And to your point, Madam Chair, these are the projections, they're the estimates. They show that we have a plan, and that plan, sort of works in theory, which is good. It means we're on this path, that's sensible and thought out and well-timed. Actuals are always where things get us. You get a big market drawdown you don't expect. You get a big shock in energy prices. We don't expect anything can change at any point. So this is in no way a prediction of the future, but it does show if we take our current plan, we extrapolate out these assumptions into the future, it at least shows that there's a plan in place for how to adjust for this. And then again, the way we deal with actuals is accounting for them as quickly as possible and how that changes.
Yeah. I want to ask RBK, is the public equities side and public, fixed income similar to this in terms of this illustration of the private side? Are we expecting to see the same thing?
In terms of the cash flow,
in terms of the cash flow.
Yeah, I think on the public side, it's different because it's not a drawdown structure. Your staff is able to add or withdraw funds at will, which makes sort of that cash flow management a lot easier on that side. But yeah, it's a balance certainly between the public and the private because you're trying to get to your target using those two sources of cash to get this balance right.
Okay, so the private side is a little bit more sensitive to the net cash flow sort of.
Well, but on the other hand, you have cash, where other funds might not have the cash flow, so they have to draw down from their public to meet the commitment.
Right.
You have cash to make this commitment, so you don't have to pay for you're already public.
Or what they'll do is they'll use cash distribution to fund capital calls if they don't have the inflows that we have.
Right. Yeah, I'm just trying to wrap my head around, 10 years from now, general fund revenues decrease because of oil and gas decline, right, production or revenue, and then what is going to supplant that? A lot of it is this on the private asset class side, but also in the public as well, should be at least.
Well, as the public side grows,
Yes.
in terms of dollars, the distribution will be larger as well. So I think overall growth, the asset base, will help supplement some of the perhaps foregone inflows that you're describing.
And that's one of the things that we'll actually be bringing to you very soon is an outlook for our distributions to our beneficiaries, because one of our biggest beneficiaries across our funds is the general fund. It receives the land grant permanent fund distributions. It receives all of the severance tax permanent fund distributions, and they also are reliant on oil and gas revenue. And so one of the things that we see is that the legislature has made a specific and conscious choice, particularly in the additional amounts of distributions it's made into the severance tax fund, but also saying we're going to take chunks of the school tax and the federal royalties and put that into the severance tax fund now, well before the peak, with the concept being you capture that and invest those excess revenues now, and they're excess in the terms that they're gonna grow and stay high for a long period of time, but eventually, we don't know when, but eventually it's gonna come back down, and we're gonna be right back where we are now in terms of total revenue into the state. So if you capture the amount while they're above that level, invest them and redistribute them back to themselves, then the hope, and what we're hoping to look at in seeing how close the legislature may be actually getting to that goal, is to say, to what extent can distributions from these funds offset general fund declines in their direct oil and gas revenue?
So if we look at, let's move on to page 82. And so we've described to you how the pieces fit together. Now we're going to show you how they fit together. So if you take a look at the chart on the left, this is our adjusted net cash flows. These are net cash flows from investments adjusted for inflows from the state land office. And one thing that you'll notice is that, you know, there is a period here of 5 years where it's negative. However, if you look at the chart on the right, on a cumulative basis, we don't anticipate it being negative at all over that time period. And if you look at, you know, essentially 2028, that's where our target allocations are achieved, and we're looking at a de minimis cash balance. Now, if you look at the next 5 years, so those, and as on the chart earlier, those are going to be derived from distributions from investments. And the cumulative amount at the end of that period is about $12 billion. And that's after assuming the negative $1 billion from the state land office over that.
Well, not from the state land
Not
office,
from,
but from inflows minus distributions
Right.
to the beneficiary.
Right. And so that includes that as well, that $12 billion.
And the highlight, I think, of this chart, when we're looking at that $7.5 billion of cash, this is showing what is the plan to deploy that cash and how long is that going to take. And so that adjusted net cash flow is looking, you know, our inflows and outflows from the investments themselves, the inflows and outflows from oil and gas, and then distributions to beneficiaries, and where are we at on just a net cash basis. And so you see the last 2 years, we've been very, very positive on a net cash basis. The next few years is where you get net negative on that. You're actually deploying and sending that cash out, so that when you pull it all together, the years where it's negative on the left-hand chart is where it's spending down all those balances, those cumulative balances that we have right now, so that eventually you
get to kind of
get to where that midpoint, where you've invested all of that cash, and then what we see happening on the back end, again, if everything goes, you know, according to plan, those then investment gains that we'll be getting from distributions from our private assets will be the cash, the big cash generator at that point.
And lastly, just wanted to give you a year-to-date update. So through the first 11 weeks of the year, I talked a little bit about, last year we had, just under $6 billion in commitments. However, a large portion of that hadn't begun investing by the end of the year. So we had a carryover of 33 fund investments, about $3.7 billion, or representing $3.7 billion. So through the first 11 weeks of the year, 10 of those funds have begun investing, and that represents about $1.2 billion, so about a third of what was carried over from prior years. And then in terms of our net cash flows, year to date, we've had net cash outflows of just under $700 million, and that includes hedge fund redemption proceeds that we received of about $150 million. So off to a very good start.
Thank you, Madam Chair. We know that this was extensive. Hopefully, we won't have to do something this in depth again, but it, hopefully, was beneficial for our new members and for the rest of the members to really understand what it is that we're doing here, how it fits into the broader scheme of things. And our goal in this really was to increase your own knowledge and comfort level of the types of things that we're estimating, how we're doing it, how we're dealing with uncertainty, and trying to be very transparent on the types of, unknowns that we're facing and how we deal with them. So I hope you all found this to be beneficial.
Do you all have anything?
I thought it was terrific, Madam Chair. I really thank you so much. It was really, really helpful. And good it's over now, because there's only so much information you can absorb, but I thought that was great, and I would be very open to similar presentations in the future.
It was excellent.
Yeah.
Well done.
Great work.
Thank
Great
you so
work.
much.
Appreciate it.
Well done.
All right, so what we're going to do is go to Liquidity 3.0 and then take a break so that people can kind of anticipate what we're doing. It was requested that we take a break. So as soon as this next staff presentation is completed, we'll do 10 minutes and then dive back into agenda item 3. Okay? All right.
Okay, well, I'll start, Madam Chair, and we'll, you've seen some of this, so I think we can move through it at a good pace. I'm so pleased we're finally getting this to you. That took so much work, over a year, went into this presentation that you'll see today. And it took that long because there was that much work behind it. We heard some good news from Don and Nino. The good news is not over. And we'll show you the rest of it here in this presentation. Historically, our returns relative to our peers, we've added about 35 to 50 basis points over the median performing fund, of large, public funds like us. Just getting to our asset allocation targets, which we're usually under because we're raising them on the private side. Just getting there, I think, could add maybe another 15 that gets us up to 50-ish. And if we use a little bit of leverage, which more and more funds are looking at, and several funds have engaged in, it's another 50 for a total of 100 over the median plan. Look back in history on 10-year periods, that puts us on top of the stack. So the good news is continues to come just because we are in a position to be able to do this. And see big inflows that have come in. It's setting up a large, private side of the portfolio that just throws off cash, as you saw in those out years. We're just in a very, very good financial position in the fund to push returns forward and really make very good returns relative to other public funds, with what other public funds are able to do for their states. We're just in a really good position, and this presentation kind of goes through that.
Thank you, Madam Chair, and Vince for the lead-in. This has been, I think, at least part one culmination of a lot of work, and staff on and Vince in particular has been instrumental in this effort, and I think ties in nicely into a lot of the components that we heard about today. Cash balances and the windfalls there, trying to get to our target allocation, and also being mindful of the growing assets overall and having all the available tools in the toolkit that are available to you given your favorable cash flow dynamic, size, and sophistication of staff. So these are some of the common themes that we see across other large plans that have implemented and started to utilize this type of tool, as I'll call it. If we can go back one page, I just want to sort of lay of the land. This is a very, I would say, meaty topic, so we decided to break it into two pieces intentionally, also to solicit any guidance and feedback, particularly on the second half of that relates to implementation, but also importantly governance and investment policy framework. I know areas that the council feels very strongly about, so we didn't want to jump all the way there. We wanted to reintroduce this topic as a continuation of a series of efforts that span almost I would say a decade at this point, but really also give you an opportunity to provide collective groups some feedback. So we'll go through that. We'll provide you sort of why and the potential opportunities for something like this, and give you some information in terms of what other funds are doing. I know there's been discussion around that and just understanding our we'll do all that, and then we'll come back later in the year, as I said, the implementation, governance and reporting, all important aspects for you all to fulfill your duties. So no vote, required today, but at some point, it certainly would. I would also say that, this is not a mandate or prescription. It's having flexibility, for your staff to manage the growing assets and the complexities of the fund. Most of them are positive, as we've heard. Having a lot of cash on hand and having more cash coming in and trying to get to your target, these are all high-class problems, but they still need to be managed. And as Vince said, there's lots of opportunities in terms of picking up incremental return or just taking advantage of market dislocations, things like that. So this is not to say we need to act on it immediately, but just having that flexibility built into your governance framework is critical to get ahead of when the opportunities or the need arises that your staff is prepared to act. On page 86, so you might be wondering, especially those newer on the council, what does the 3.0 mean? Well, it's the third iteration in this series of liquidity work that we've undertaken collectively. And the first one was back in 2016, 2017, when we looked at the overall purpose of fixed income, the sizing of fixed income in terms of there was a recognition that you had cash coming in, how much fixed income did you need at a time, and fixed income didn't return or didn't have the same kind of income or yield that we have now. Again, that was in a zero interest rate environment. We said we'd really like to hold as little fixed income as we need and just hold as much to be able to rebalance and sort of make distributions and be able to meet the bare minimum. And this analysis was helpful and instrumental in that, in terms of helping set the sizing of your fixed income portfolio. But another thing that came out of that is the split or intentional bifurcation of your fixed income, which was previously a very broad category, into very safe capital preservation focused investments like treasuries and things like that. And then the other side of that, that's more on the plus side, where the emphasis is maybe not so much on capital preservation, but more on income generation, diversification, and other aspects. And historically, those were always lumped together, and I think very, very intentionally here broken out. And so we learned a lot from that, and that was reflected into your asset allocation over time, and has been with you, and over time that number has actually come down, in part because you've had strong cash balances. Your staff has gotten really good at managing cash flows and doing the types of analyses that Nino and Don just presented, really looking forward and saying, how much cash do we need? But the other side of that is having a position now where your inflows just about cover, or in some cases cover, your distribution. So you have no risk in terms of needing a lot of liquidity in the portfolio, as you heard. So that is a very advantageous position. I don't know really of any other fund that is in quite a good shape as you are in the country. And so that presents a lot of opportunities, but as I said, also some challenges, high-class problems that need to be managed. And collectively, we think that this 3.0 leverage concept could be helpful in managing that even better than already being managed. So with that, and it was great that Don and Nino went first, because we can skip through some of the slides in here that pertain to cash flows, and so we've well established and understood that the cash flow is a windfall. It's a high-class problem, but still one that needs to be managed, and so leverage here in this context is one aspect where it could be helpful. Maybe skipping further ahead towards 92 and 93, we've described an ability, but also perhaps a desire to look how much we could move into private markets. You've already made some moves there, because the adjusted return prospects tend to be higher there than on the public side. And you, as a long-term investor, really as a permanent or perpetual fund, you have a extremely long time horizon. You do have the ability to invest for the long term, which is one of the key requirements requirements for these private market investments. The other thing that oftentimes, even if you're a long-term investor, is do we have liquidity? Well, got liquidity coming in, and this here enhances liquidity, or at least allows you to manage it even more so. So we think it's a very good tool for that aspect, but it also serves other purposes. Other funds use leverage, which I know is somewhat of a scary term, and oftentimes has a negative connotation to it, but it's actually quite prevalent across most portfolios already, and even across our own individual personal balance sheets, as we'll see in a couple minutes. A couple other aspects that this could be helpful in is getting closer to your target allocation, and that's important because you can set a great asset allocation, but if you can't get there, or it takes you forever to get there, then what does it mean? So a tool that not only helps with liquidity management, but allows you to get closer to your policy prescribed target allocation that you all have set, which really is also a risk exposure, right? Because at the end of the day, your asset allocation is how much risk you're willing to take, is another aspect. But also, when liquidity matters most, or when opportunities present themselves that we don't anticipate, or events like 2008, or at the onset of COVID pandemic, when the markets fall apart, we have a big drawdown. Taking advantage tactically and intentionally taking advantage of market dislocations such as this is also helpful, because typically what happens is your equity sells off, right, in these large market drawdowns, and that provides some inability to rebound, because you're not necessarily going to be able to move without perhaps taking some haircuts in other areas, and your private market in particular would be the area where you might want to take some cash off the table, but that's illiquid. We know that, so how do you rebalance? So that's a challenge.
It's Member Tejas who's pointing out the phasing and the effect on
Public. Absolutely. So it allows you to be able to look at those more independently rather than sort of saying this versus that. It gives you the ability to take advantage of those without holding more cash than you might want to. Even though currently it's not a problem, down the road, as Don showed you, it's not linear. There's different periods of time where the cash balances will look differently. But even then, is that use of cash? These are all the kinds of things that need to be considered and contemplated, and those will shift with market regimes and market dynamics. And so it's something that is helpful to have, as I said, as a tool, but there will be times where it makes sense to use it, and other times where it may not. And so having the right structure in place and guardrails that you all are comfortable with is something that it could really be helpful for staff in terms of management and implementation of the overall portfolio. On page 94 and 95, just kind of getting a little bit into leverage. There's different kinds of leverage. You already have embedded leverage in a lot of the asset classes now as just a byproduct of how those assets are managed. And then there's the second layer, which is portfolio level leverage that's put on top of the entire portfolio to magnify results overall. But the concept is quite similar. Point being, leverage broadly is not a new idea or a new concept to the SIC. You're using it across your portfolio already, and I've gotten quite good at doing so. Some examples of that is on page 96. For public equity, or fixed income, real estate. In fact, in the real estate portfolio, you already have some language in your policy around that. Private equity to some degree. So it's in most of your asset classes, just not at the total fund level. The total fund level leverage can be useful for all the reasons that I described. Those are found on the bottom half of 96. Either tactical way, so it makes sense based on market conditions, but also strategically, if you take on small amounts of leverage consistently in order to pick up some incremental return. Another way, you can reposition your portfolio. In fact, some asset owners are doing that, 50 degrees of success, in terms of, trying to hold less equity risk and having a broader exposure to the various, risk metrics or risk aspects, because equity risk tends to dominate any normally allocated portfolio. So there should be a desire to do that, or at least an opportunity to do that, and then hedging some explicit risks that you may be interested in, but that's sort of probably a lower level type of opportunity. Page 98 describes all that in more detail. I won't go through it. I certainly agree there's a lot of information. If you want to dig in a little more, please take a look at that or ask questions. On page 101, talk about strategic versus tactical purposes. It's not intended to imply that these things are mutually exclusive. These are all very custom bespoke, I would say, programs that most of the asset owners or other plans, your peers, have adopted depending on their unique needs, and I would expect your program to look different than all the other ones because of your very favorable cash flow profile, for example. And so that gives you a lot of flexibility around that, but not intended to mean that they're mutually exclusive. Certainly opportunities to use them across a multiple set of scenarios. I'm going to fast, please let me know, but I'm very mindful of time, and I know we still have a long agenda here. Page 102, I think, is especially for those of us.
Yeah, just one question, because you went over leverage. Can you just kind of comment on leverage? It's really interesting how you put this together in the presentation, but under our situation, is that even needed with so much cash on hand and that sort of thing? Does that help with our ability to maybe save some costs associated with investments on not using leverage, or?
Yes, depending on what you're sort of using it for, the answer is yes and no. At present, with a high cash balance, probably lesser of a need for that. But as you saw, that cash will be drawn down as well. And then, it's always I would say a matter of, is this the best use of your cash, or if there is perhaps more attractive capital available for you to achieve a certain objective, then maybe you go that way despite having cash. And real yields, for example, is one decision factor, right? If you're earning a real yield on your cash, it's really not a drag on your portfolio. You to equitize that cash if you wanted to, so that you don't have any cash drag at all. So there's different options, but your point is spot on. At present, it's probably less needed as it may be in the future, but the whole idea is to get in front of it. Because if we start talking about it when you need it, then it's too late. Okay. Way too late, right? And so this is a matter of setting the right framework to when the dynamics change and it makes a lot more sense. You're ready to take advantage of it.
Great, thank you.
Page 102 shows you our asset allocation model and gives you some different scenarios in terms of how this might be used, because I think it's helpful to give you actual examples. And in green, you see your current long-term target allocation with your targets across the various asset classes and your risk and return in the three bolded lines, two-thirds of the page down. And then we have three other portfolios. These are hypothetical, these are not recommendations, but helpful to illustrate how one might use leverage to achieve certain goals. And in blue, you see this is what we call the leveraged equity portfolio, where you take on a little bit of leverage and deploy that across your public equity market. So you're taking on about 10% of leverage, putting that to work, 5% each to your broad U.S. and broad international. And the impact of that is picking up 35 basis points of investor compound return, 714 versus 749. So that's one way it could be used, and especially if there's a market drawdown, equity becomes very cheap. You say, I want to put some money to work in the equity market because it just pulled off 30%. How do we take advantage of that? That's how you rather than trying to sell your private assets or sell your fixed income, which you may or may not hold enough of, especially because you don't need the liquidity for it. So then how do you get capital to deploy that? Either you miss the opportunity or you find a way to do that. And this would be one way to say, look, we really like these valuations, let's take advantage of that. As a long-term investor, why wouldn't you? That's one option. The other one is in yellow, as I said, you could readjust your overall exposures to the asset classes, and in this case, you could really ramp up your fixed income exposure, counter to sort of how you're positioned and what you need. You could go fixed income from 6 to 22%, take down your public equities a little bit.
This is public fixed income, not this.
And what you see is, despite changing those dynamics, your compound return is essentially the same as it is now. So you're holding a lot more fixed income, but you're not really giving up any return. In fact, you're reducing your risk. So it's a way to not necessarily increase risk, but to increase return, but to reduce risk. Another lever that you could pull if there was ever the time to do that. And then the last one is in private markets. To say, look, we want to go deeper into private markets because we think there is incremental return pickup in this area, and here you would pick up, instead of 35 basis points, 40 basis points in your portfolio, as one example. So 7.14 in the current long-term target, 7.56. Again, these portfolios are not recommendations, and to be illustrative of the types of moves that you could make when market conditions permit. Monte Carlo, in terms of stress testing, on the pages that follow, I won't belabor that, but obviously leverage will magnify both positive and negative returns. So having a good risk management process, good guidelines, and good solid approach to it that's prudently designed, I think is quite helpful. The next section describes the amount of leverage that you already have embedded in the portfolio. And it's just to say leverage is not new, it's not right in your face, but equities, even some fixed income strategies will use various forms of leverage in order to get there. On page 110, you see your exposure to some of the private asset classes, so not only on the public side of the book, you have it on the private as well. And there, you actually have explicit guidelines because each of your agreements tends to have some kind of guidelines, and talked about it when you get the LPAs. That's factored into the pacing. Here as well, we can see for each investment what the leverage limits are, what the guidelines are. You can see that you use leverage across most of these different asset classes. Not new. This would be utilized in a different, slightly different way. And the next section.
Is there a question online?
On page 112, that's the next section. That's looking at peers, and Dawn and us collectively, we had conversations with lots of the peers, especially the ones that we thought are using programs that would most closely resemble a program that would be attractive and beneficial to the SIC. Had those conversations. The staff counterparts at those funds were all very helpful and eager to share their experiences, both positive and negative, although for the most part they were positive. I think the challenge really was more on the reporting and that decision makers were in the loop and felt like they had a good understanding and opportunity to weigh in on this thing. So it took quite a while, but I would say that's probably the biggest challenge that your fund expressed.
They all do it differently.
They all do it differently, and some of those tiers are listed on page 112. Some of them use it at the total fund level, others use it at the asset class level. We just talked to both to get the broadest set of experiences, but for your purposes, really the peers listed on 113, where we look at just the total fund level, are likely the most applicable. But in terms of their objectives, in terms of their staff composition, in terms target, their assets and their asset allocations, their goals, but also some of their constraints, quite similar, to the SIP. So we thought they were reasonable proxies in terms of experiences for that.
Madam Chair, they are pensions though, right?
They're larger pensions, yeah.
Yeah, and so the cash flow on a pension is based upon the contribution of the members, and ours is
Right.
a lot different and very much more complicated too. Does that affect things? I mean.
Yeah, I think it makes the math, the break even a lot more in your favor, right? Pension funds, not only are they not cash flow positive, a lot of them struggle just to make the required contribution. So it's a very, they're not contributing as much as they should be, in a lot of cases. So yes, they don't have quite the same flexibility as you would, and in some cases are using that to manage some liquidity, because kind of what happens is if you're underfunded, what you end up doing is wanting to invest in private markets because you have a gap to close. You want to get the full funding 100%. How do you get there? You get there with the highest returning asset classes. Those also have the liquidity. So if you're paying out a lot, if your payout ratio is high, how do you get there when you need more return, but you don't have the liquidity profile to be able to invest there? That's the conundrum. And so some of them are using this to help close the gap, but that's really a funding issue more so than an investment issue.
Some of them are mature plans that are getting, like Nikita said, they're getting less contribution in, they have to pay out more than they're getting in. Some are still younger plans, so it's across the board. You see the difference in funding. Active plan here is 100 million.
Yeah.
That's rare.
I saw that.
Well, sorry, the third plan is 125. And what's really interesting about them is their funded status is 58%, so they have 58% of the assets produce 100% of the distribution. It's likely they're also getting contributions that are less than their actuarial. They're really trying to do something here.
Yeah, and that's one fund that's not shooting for the stars. They're trying to mitigate risk more so than others.
May I ask a question?
So
May I ask a question on, you picked peers that are supposed to be similar to FIC. What factors did you utilize? Because when I look at, is it the dollar amount that you mostly focused on, or is it the asset allocation that was mostly focused on?
Yeah, well, number one, it was who's doing it. And so, 5 years ago, you'd be hard pressed to find a lot of funds that are doing it. We wanted to talk to funds that were well respected, that have been doing it for a while, and that would be reasonably similar. Now, Member Tiff already mentioned a lot of them are pensions. So there's some inherent differences there, but in terms of really what is their return target, so where are they trying to get to in terms of an asset allocation, what is the sophistication of the staff and the staff resources. Although I think we all agree that you're punching above your weight class in terms of what you're doing with your staff. A lot of the other staffs are more richly resourced, so I think that has to be recognition as well. And then overall, sort of what's the funded status and the asset allocation. But yeah, there's no perfect fit because you are so unique in terms of your overall profile and uniquely positive, I would say. I think any of these funds we talk to would say, why? You have positive net cash flows and you have a distribution policy that looks like an endowment foundation. I mean, you've worked hard to get to this place.
What percent of plan? I mean, it's a small, it's not.
It's a lot more prevalent than it was even 5 or 10 years ago, but it's still a minority.
Yeah, for things, finding somebody who's been doing it a while, that limits who we wanted to talk to.
I see that FIC is 50% private asset target. That's what our target is right now? Is that what we're saying?
That's our current strategic asset allocation. If you, now of course, we're not at our long-term target, and that was part of the pacing to get there. But the strategic asset allocations that you all have approved, if you look at private debt, private equity, and real assets together, they're at about 50%.
Oh, together, okay, never mind.
It's closer to
I was like, no, okay, got it.
we've
The
got
three added.
40%
Yeah,
public
they're
equity
added,
and
yeah.
6
Got it. Got it, thank you.
So these pages really is intended to show, you wouldn't be the first adopter, but you would be certainly, among the plans that really has the right, ingredients to make this, be successful. And again, this would be with an implementation partner. This would not be managed by staff. This would be, the council sets the guardrails in terms of what are the limits, what are the right components to this type of a program, and then staff would work with a third-party implementation partner, firms that essentially specialize in that. It's a relatively short list of qualified partners that can do just that. And within that, there's a range of, kind of getting into part two of it a little bit, but there's a range of arrangements as well. So you could have it almost on autopilot where they manage it based on framework that you give them, or they only ask from staff that let's make a change. So there's not I would say a one size fits all. Page 117. Also, of course, not just we had long conversations, and they were, as I said, very helpful in terms of sharing their experiences and materials that they were using. I would say what was commonly well defined is objectives, how they're thinking about it, how they're using it, but I think largely left a little bit to be desired in terms of their reporting. Reporting seems pretty light, and you've been stepping up your efforts in terms of monitoring with the reporting that you're getting there, and internally how it's being measured. So I think you would absolutely be, at least from what we've seen, at the top of the heap in terms of providing good ways to monitor the exposures and your overall risk metrics around a program like that. And as we were talking with some of the implementation partners, we also learned that a lot of the information and data that they have will feed directly into for risk management. So that would be another added benefit. Page 120, this is, and I don't know that we necessarily need any information or guidance today, but points we wanted to leave you with that would be very helpful for part two as we think about it. Obviously, staff and us have talked about it and are thinking about it, but really want to incorporate your feedback and guidance as you're thinking and reflecting on a program like this. These are some potential questions to ask yourself as you're thinking about it, with some commentary and rationale provided that might be helpful as you consider it. But wanted to present these to you. A lot of them we touched on, whether tactical or strategic. As I said, I don't think they have to be mutually exclusive, and yours are not seeing them in that way. Whether it's reflected in the asset allocation, how it's benchmarked, how you'd like it incorporated into your reporting and the policy. These are all, I think, very important considerations. So, some of you probably have strong thoughts and feelings on that, and we just want to make sure that everybody has an opportunity to share that either now or at a later date for us to consider and make sure we address it. I'll stop here, but happy to take any questions or comments, or Don and Vince might have some additional comments.
Madam Chair and council members, I know we had to kind of rush through this, but this is the first of a multi-part presentation that will make you in advance of a request. Please go back, look through the slides. I know we didn't have a chance to cover them all. Think of these questions, because you'll obviously have questions when we come forward to you with the request for portfolio level leverage. And we want to make sure that we've presented you with all of the things that came to our minds that you might want to consider as part of that strategy and that request.
So then let's open it it up and see if items that folks have, and I don't mean to ignore the folks online as well.
Madam Chair?
Yeah.
It looks like you're suggesting that this go back to the, governance committee. 5 on that list.
For the investment policy statement specifically, I think just as part of that broader policy discussion.
You choose to.
And the next page, page 121 has, just for those that say, well, what might be covered in part 2 of the two-part presentation, we have that listed there in terms of implementation options. But if there's any governance reporting, there's additional line items you would like to explicitly have addressed. Let staff know and we'll make sure that it gets included.
And I just to add to that, it's good that you point that out, because if in the event we decided to add portfolio level leverage, there's a whole level of governance issues that would need to be made around that. So at no point would it be a staff request for portfolio level leverage and that's that. Like there would be investment policy statement guidelines, a lot of considerations around the guardrails, the oversight, the reporting. So it's sort of making that aware at this stage, just the types of things that would need to be considered and included if we continue pursuing this as an option.
And Madam Chair and Member Sommer, yeah, this really does go into the discussion of what does the council want these funds to be? Where do you want to go with this? This and an upcoming presentation from Dawn about the state's revenue tipping point and how our funds could interact with that really go into what is your desire for returns, what is your tolerance for risk, what should our asset allocation be? It's really all wrapped in together.
Madam Chair, what's the cost of this?
To have a partner like this, it's quite cost effective. It depends on the overall size of the program, but it would be somewhere around 8 to 10 basis points. It would be one of the cheapest.
Generally, Madam Treasurer, the leverage that we would be looking at using would just be in the derivatives markets, so primarily futures. We could use swaps, but primarily futures markets, and the cost of that is roughly the rate of cash. So we can take on a futures contract for whatever size we want in the equity markets and pay about the cost of cash.
I think part of your part 2 have a full picture of cost, how many entities are in this realm, what area you're really wanting to focus on doing this for, how much you're thinking you would actually earn on a rate of return in an increase by doing the leverage. I think for me, I tell my team this all the time, they always want me to make decisions, but I never get the full puzzle. And so it's hard to really focus in on one thing when I only have a piece of the pie instead of the full puzzle, so I could say, all right, this really makes sense for the direction in which we're going. I think that's important to look at. I'll just say, I appreciate how will success be defined and measured. I think that's a important point to bring up in further discussion. And we're always going to be asking about, metrics and how do we know if this is working, and I appreciate that as part of part 2.
Yeah, and the cost, of course, as well, and there's 2 components to that. The first is the cost of leverage, but then there's a second layer to that, that's basically de minimis for the implementation partner. That's a couple basis points. But really, when you think about it, it's a little bit, yes, there's a cost of the leverage part of it, that is closely aligned to the cost of cash, but the idea is to redeploy that in higher returning asset classes. So what you keep is different between cash versus what you might earn in equities or other assets.
Would you all be open, and I don't know how we get this, if maybe we just get it to you, Vince, would you be open to folks continuing to think about, the way that I'm thinking about this is, if you were asking me to vote on this next month or right now, what additional pieces would I need?
Yeah, please.
And so I'm wondering if we can continue to,
Everything you want to know and things that are in here that we didn't focus in on today.
spend time on, yeah.
Yeah. Is process.
We'll get those to Vince, maybe.
Yeah, and if it's only derivatives or futures, what that total is in our portfolio today, what it looks like for what that cost would be, and based off of the example of today, how much are we gonna earn in addition to because we did this? I think it's helpful.
Sure. Yeah. But we want you all to be comfortable, so there's ideas to answer all the questions. Thank you.
And then, of course, with Mr. Schiff, we already have it in our budget.
Yeah, this is maybe a little bit different because the costs are kind of embedded in the instruments,
on the
as I
back end.
understand, so.
I forgot, you said 10
The implicit
basis
cost
points.
is very small, and the other cost is not a really, line item.
And Madam Chair, Madam Treasurer, to both of your points, that's actually why it's incredibly helpful for you all to actually send us these questions. You know, to the extent that we're writing notes today, we may or may not get the full picture of exactly the types of questions you have, but there is every intent to answer them, and to make sure that we're meeting the comfort levels of staff and council in the entirety. So as those questions come up, you think of them, please send them to us, because each iteration of this, we should be and are attempting to address any of those questions that you have. So making sure you send those to us helps make sure we capture everything in case we didn't quite get a note today.
So I'll tell you right now, I'm not gonna have enough time to do that at this point. But I would say, put yourself in my shoes. If you need to make a decision, what would you need for that? I need to have total cost, I need to have how much of the big picture is this little piece. Compliance, is it somehow connected to anything statutorily? On the investment policies, or anything that we need to implement or add in? On the internal controls, do we have it in place or do we need to implement them? Do we have the policies and procedures within the SIC to be able to do that? Are there checks and balances within that portion to be able to get it done? And overall, how does this tie in with fees, with maybe even on the budget side or on the back end on the fees on if it's basis points? Those are just some of the preliminary things I think about when I'm trying to make a decision on, is this the right direction for us to go in?
Absolutely. And then the questions that we provided at the end cover a lot of the sort of the general idea of a lot of the things that you're thinking about. So we are trying to do that, to think about what are the types of questions that you would be asking, and how do we just go ahead and answer those for you. So I appreciate that feedback.
Anything more on this agenda item? All right, we appreciate that. Thank you all very much. So it is almost exactly noon. We're gonna take a 10-minute break, please. Actually, according to my standard, Greenwich Standard mean, it is, so we'll come back until 10.
Another hour.
Totally.
Right, yeah.
Evan needs to tell me if this is possible. Just, skip down to 3J and do that before we start with the investment.
You may order and whatever way, assuming council is with you.
Is there an objection? We have a member that wants to be here for that and may have to leave.
Yeah, actually, I don't have to leave.
You don't have to leave?
I don't have to leave, I rescheduled everything, so I'm good.
Okay, then we are proceeding as usual, what the agenda lines out. And we'll start with our investment committee chair, Member Bingaman.
Madam Chair, thanks very much. We had a good meeting last week. We did have a quorum, and we unanimously recommended all of the items that the staff brought forward, so we can recommend those to the full council today.
I gave this guidance last month as well. I'm going to encourage brevity, particularly from our visiting managers. If you could, give a real high-level overview and just basically stand for questions would be great.
Great.
If folks want to really dig into these matters, I advise you to attend the investment committee. Okay. So, without further ado,
But I will say, Madam Chair, if we could make sure for next month that the internet, all that stuff works for us to be able to attend online, it would be very, very helpful.
all right.
Madam Chair, Madam Treasurer, are you referring to the investment committee?
Yes.
So it was an issue with the calendar items set up by your staff. They took the very first Zoom link of for the entire series and put that for every calendar item, whereas we use a different Zoom for every item. So we send out the Zoom link every month as part of that email, and that's where to find that correct.
That wasn't actually what I was talking about, Madam Chair, but in that point, on the calendar item, it should have the Zoom link and the agenda and the attachment. That'd be helpful to anyone who wants to join. What I was referring to more was the line kept getting disconnected, everyone was black on the screens, people couldn't hear that we're in the meeting, so then the people who were presenting online had to represent. That didn't.
Madam Chair, Madam Treasurer, agree. I think I have a different view of IT infrastructure than my predecessor perhaps did, and I believe in overbuilding it so that we don't have problems like that. We have been experiencing a variety of issues like that, both in our Santa Fe office and Albuquerque office, and we're working to upgrade our IT infrastructure so that we don't continue to have issues like that. And I do apologize, because I know that was really frustrating for everyone involved, both in the room and on the phone.
Great to hear. All right, so we're moving on to, I think our first of 4 investment votes, New Mexico Private Equity, DC, BC, Climate Select, and we'll turn it over to our ACD. That's what they've been calling you guys.
This is an investment for the New Mexico program, and this is an opportunity that we've been working on a while. We're recommending a commitment of up to $50 million to DCVC Climate Select, which is a fund which makes mid-stage venture capital investments in companies developing deep tech-driven solutions to global climate problems. As we've discussed in the past, the climate crisis is a physical problem. Most of the companies in the space have a significant hardware requirement, and that can be very capital intensive, and, the only way to scale with meaningful impact is you have to have the capital to do it. And so, we've made a number of investments in climate tech over the last year in the New Mexico program. They focus really on the early stage side, which is where the science for these kind of projects is de-risked and customer need is identified. Keith Sable and his portfolio on the infrastructure side, he looks at later stage private equity and infrastructure funds that finance well-established projects like wind farms and solar arrays. And there's kind of a messy middle stage venture where the science has been de-risked, you have to start building pilot and demonstration plans. And this requires a lot of capital in order to demonstrate the commercial feasibility and scalability of the technology. And the kind of technologies we're talking about, which DCVC will discuss, and all of these are potentially could be deployed on state land. Things like next-gen geothermal, water treatment and purification technologies, and methane leak detection technologies.
on the geothermal side, which is a really interesting opportunity probably for the state, is we have one of the largest dry hot rock geothermal resources in the U.S. Wanted to pass it along to Bruce. He's not spoken at a meeting yet, but Bruce, something I've been working on, this climate tech stuff for a while now.
This is something we've been working on for a while. It's climate tech as an investment area is getting much bigger. It's something that people have known about for a while, but it's new to our program. New Mexico is very well situated to take advantage of this new area of investment. We've got sun, wind, and geothermal, as well as the scientists. All of our labs are working on something to do with climate change. So this should be a very fruitful area for investment. We're getting a lot of inbound interest in this. A lot of people want to invest in this, or want to invest our money for us in this space, and we appreciate that. But it is an area of great expertise. People have been doing this for a long time. DCVC has been doing this for a long time. They've invested roughly $360 million over the last 10 years in climate tech, and have doubled that money with an IRR of 20%. So they know what they're doing. One of their people on staff, I'll talk more about it later, but is a woman who has gotten a PhD in nuclear science. She spent a lot of time working on this. She's very dedicated to it. She's forced these things. So it's not like these people come to it lately. They've come to it with a great deal of expertise. They've done it very well, and there's a reason why we're picking DCVC as opposed to anybody else who's come to the table saying, I can invest that money for you. These people have a lot of expertise, and with that, I guess.
I'll just focus on the fund. DCVC is a new relationship in the New Mexico program. Just to step back a little bit, DCVC is an organization that has been around for more than 10 years. They're a venture capital firm which really started focusing on deep tech companies. They manage early stage funds, opportunity funds. They also have a platform called DCVC Bio, which focuses on human health and biotechnology. And the fund we're talking about today is the Climate Select Fund, which is another one of their fund lines. We like that DCVC has a large and experienced team. They have a variety of experience, really a mix of investment, technical, scientific, and operating backgrounds all on the team. They've hired 2 individuals to work exclusively on the Climate Select Fund and climate opportunities in particular. The firm has augmented its investment team with operating partners that can support the portfolio companies. And one consideration with a firm like DCVC, they've had a lot of growth over the last few years, is ensuring that they have enough people to really manage those additional capital. And we think that they've shown a good pace of growth in the team as they've grown their business lines. From a strategy perspective, even though this is the first climate-dedicated fund that they're managing, they have experience investing in climate-related investments in their other funds. They're going to be targeting more mid to later stage companies in this fund. The performance of their prior climate investments has done well to date, although most of that value is still unrealized. And the firm's other funds have also generally performed well on an absolute basis and also compared to a broad venture capital benchmark. With that, I'll turn it over to Zach. He's one of the co-founders and a managing partner at DCVC.
Hi, guys, and I'm here with Allison Kaufman, our head of IR, Investor Relations. And yes, I am the co-founder and managing partner of DCVC. We are a deep tech venture fund, and I'm here to talk to you today about DCVC Climate, which is a deep tech climate venture fund investing at the mid-stage of venture capital. And if you guys have the deck, I don't know if everyone has the deck, but if you turn to page 173, I'm going to start with the example that these guys alluded to. This is Fervo Energy. Slide 173. Fervo Energy is advanced geothermal. These guys come out of the fracking industry, so they know how to drill down 2 miles, drill laterally, and they fracture the rock below the surface. They don't fracture shale, which is what you do to produce oil and gas. They fracture granite, and it produces a terrific surface area to create geothermal electricity. Their first plant, which is in Nevada, is up and running. Google's the first customer buying all of the electricity, and that deal is actually underway, so money is changing hands. Their second plant, which is in central Utah, is going to be a 400-megawatt plant, and a quarter of that will be on the grid in a matter of years. And they also have a major leaseholding in New Mexico, And that facility could bear up to 150 megawatts, but they also hope to scale into potentially thousands of megawatts in the state. But just for context, 150 megawatt plant, that could create thousands of jobs, as well as that contract value under current market pricing would be sort of in the billions of dollars, total contract value. So that just gives you a sense. And I would just say that sort of across a handful of our companies, we have partnered with New Mexico already successfully, and we sort of welcome the prospect of partnering further. That's because of the business climate, the political climate, the land use climate, and also the workforce. There's a just terrific workforce in both renewable as well as conventional energy, and those are the types of folks that really help us scale businesses here. That's Fervo Energy, and that's a good example, and that's sort of, sort of our history of partnership thus far. And I'll take a step back. So I've mentioned deep tech a few times, and if you want to flip, that slide was just slide 157. So what is deep tech? So deep tech just means that we like to back entrepreneurs that are solving hard, real-world problems computationally. They're using advanced AI and ML to solve hard, real-world problems. Problems in the climate are just a subset of that. Obviously, AI is having a little bit of a moment right now in the press. We've been investing in it since we launched the fund in 2010. We've also been, as these guys alluded to, we've been investing in the climate for a dozen years. We like to say we've been investing in the climate for a dozen years on a deep tech perspective, and it became popular to talk about it about 2 years ago. And so what does the deep tech model look like a layer down? That means we back experienced entrepreneurs that have access to a proprietary data set that are applying world-class machine learning or other algorithms. And the way to think about it is those AI algorithms operate on that data set, and then that data feeds back into the algorithms. It enriches the data, and then that enriched data feeds back into the algorithms, and you achieve this virtuous cycle. It just gets better and better. The output of that virtuous cycle is that it's a massive reduction in the CapEx, the CapEx and the OpEx, the expenses required to scale some of these problems, solving these problems in hard, real-world solutions. And then on the next slide, on slide 158, you can see sort of all of these bubbles. DCBC over the years has successfully deployed capital behind entrepreneurs that are disrupting sectors within all of these bubbles. Some of these are climate related, obviously mining and energy. Some of them are not, biopharma. This is across DCBC broadly. But what do these sectors have in common? They're hard, real-world sectors that have existed for decades or hundreds of years in some cases. And as an entrepreneur with a startup, how do you hope to compete with one of those industries where they have, in some cases, trillions of dollars of installed infrastructure? You compete by having a clever computational approach. These CapEx-light models where you're substituting compute, AI, and algorithms for capital expenditures. And with these CapEx-light models, you can make a lot more progress and hope to disrupt one of these sectors that's up on the screen, like chemicals or energy. And so that's what we're about at DCBC, and that's why we think we can produce venture-scale returns, and we've demonstrated we can, investing in climate tech. So I'll hit the team quickly. I realize we want to be brief, so cut me off if I'm going too long. Slide 161. My quick background is I moved out to the Bay Area of California after law school during the dot-com boom. So I've seen a few of these boom and bust cycles, which I think is helpful. I moved out to work for a big Silicon Valley law firm called Wilson Sonsini, and I did venture capital IPO for the first 2 years of my career. A great way to start my career, but then I realized I didn't want to work at a big law firm, so I left and started a handful of companies. And in the 2008-2009 timeframe, I became really interested in hard problems and applying computational models to hard problems in the climate. I have a background in environmental science from Harvard, and I had the idea that the emerging big data wave at that time, that could be applied to the hard problems of the climate. We started seeing massive data sets emerging in the building efficiency space, in the utility space, in the energy space, and everyone's databases were breaking. So at that time, I met my partner, Matt. He was also excited about the emerging big data wave, and we co-founded DCBC just around solving these hard, real-world problems computationally. 14 years later, this is where we are. And then it's not just us, and so if you go to the next page, 162, this is the broader team. And I'm not going to go into too much detail here, but the headline for this slide is that DCBC, we operate much more like a football team than a golf team. It's a unified team. Everyone's incentivized to weigh in, to really help make sure all of our companies win. This is because On our team, we have more published scientists than MBAs. These are, by definition, hard problems in the climate, hard deep tech problems. They're multidisciplinary problems, and it requires everyone to be able to dive in and help because everyone's got a different skill set. And I'll call your attention to there on the second row from the third in, Dr. Rachel Slabaugh. They referenced her earlier. She was most recently a tenured professor of nuclear engineering at University of California, Berkeley. And her specialization was in computational models for modeling fission reactions in nuclear reactors. So she is a deeply technical person. She is a core part of our team. She sits on boards for us. She also has known the industry because of some of her experiences working with the Department of Energy's ARPA-E program, as well as with Cyclotron Road, which is sort of came out of an accelerated program coming out of the national labs in California. And she's also engaged, and we've been engaged with the analog of that program called LEAPS, which is coming out of some of the national labs here in New Mexico. We think there's just terrific deep tech comes out of the national labs. It's a real asset to have these national labs in your state. And that's the team. I will keep rolling. And then, so what are we investing in? Why are we mid-stage? So this is, if you go to slide 165, sorry, I'm bouncing around. But slide 165, this is called the missing middle in climate tech investing. There's lots of folks at the early stage. There's lots of folks follow-on capital, sort of infrastructure and project finance. There's not a ton at the middle. That's why we like this area. It's also a lot harder to invest here. This is where companies have probably reduced, or we like companies who have reduced their technology risk. So technology risk is reduced, which reduces timeline risk. But it's also time, it's before they have material revenue. It's before the big boys, the big funds can really come in and understand, is this a scalable model? So we like to engage here. We like to help the companies fully retire their technical risk. Investing in technical risk and understanding technical risk, that's our core competency at DCBC. Our other funds go a little bit earlier. This fund, this goes here, and we can actually understand the climate tech company has eliminated its technical risk. We also help these companies scale their nascent commercial traction. Once they have hit, a sufficient amount of revenue and commercial traction, then it unlocks all of that capital on the right side of that graph, and that sort of really de-risks the company. You need to bring in project finance. You need to build big infrastructure projects. And we've, successfully, for one of our other portfolio companies, I won't go into details, we came in, we led the Series B financing, which is sort of our model at DCBC, and then we helped unlock, through our process, $400 million of project finance and $50 million of equity from TPG. So that's sort of our models. We unlock all of this capital because these guys referenced we need a lot of capital to scale these models.
So I'm going to ask you to make your concluding remarks.
Phenomenal. That is, I think you get a good sense of it. I'll end with just a quick example. Kairos Aerospace, slide 175. This is probably our most impactful company, also with terrific revenues. So I'll just start out with the revenue. These guys are, they do methane detection in the Permian Basin. They've done material work here in New Mexico's portion of the Permian Basin. And these guys have bigger positive impact on the climate than Tesla, and they're just getting started. This is from Tesla's 2022 impact report. They reduced 60 million tons of CO2 emissions equivalent. Kairos was at 70 million tons. So, and these guys are just getting started, whereas Tesla's a $1 trillion company. What they do is they fly sensors on planes over installed oil and gas infrastructure, and they help owners of the oil and gas infrastructure stop the leaks. Huge benefit for the climate, but it's also the product for those companies, so it's revenue accretive. Like I said, they're going from about $12 million of revenue next year, likely doubling or tripling it this year. So it's a terrific growth stage climate company. This is not in the fund, but it's just another example of the types of stuff we do to generate real venture scale returns and have impact on the climate.
All right, great. I appreciate it. We're going to start off with Member O'Donnell.
Thank you, Madam Chair. Great presentation, and I'm really particularly compelled by the investment in the methane detection technology. Question for you, really about your first slide.
Yeah.
You started in talking about a very large geothermal project, 400 megawatts, I think you said. And so I'm kind of trying to make the link between mid-stage companies, computational strength, and this great big infrastructure project that we started with. So can you help me kind of bring the pieces together?
Sure. So that's Fervo Energy. That's the second deal in the climate fund. So we have an existing equity investment in that company, and we basically, led the Series C financing. So we own shares in the mothership company. And that's the company that owns the intellectual property, and then they have all of these subsidiaries, and some of those subsidiaries are leaseholders here in New Mexico, and then the subsidiaries get project finance, and they build out these power plants. So we invested in the Topco, and some of our money goes into building those big rigs, or paying for those big rigs, or building the infrastructure, but some of our money just goes to perfecting the technology and helping secure that bigger project finance. It's a computational AI company. These guys, as I mentioned, have drilled the most productive enhanced geothermal well that's ever been produced. They do this through better geological modeling. These guys have a core competency in being able to understand, it's a massive data set, just to understand what the subsurface strata and what's going on below the surface. They also have highly instrumented drill heads. So as they're drilling down, they're collecting just reams of data about how hard is the actual rock when metal hits the road. And then they actually have just announced a 70% reduction in their drilling time based on what was previously thought to be able to work. This is all publicly announced, and so that's just a product of better computational modeling of the geology and also the drilling. Does that make sense?
It does, yeah, that makes perfect sense.
Yeah.
The commitment is 50 million, but I saw something in there about 400 million. Is that what we've done in the past? Is that the total of the fund?
That's the size of the fund.
And Madam Chair, based on what we've done with them in the past, what has been, completely new. I thought we had done something in the past. Okay, so then I have a question to your football team.
Right.
You've had 3 partners leave in the last 5 years and 2 new team members come in the last 2. Can you just talk a little bit about, we're talking about a football team, like is it a star linebacker or quarterback? Or, what are we working with? Because the longevity of the production and the IRR of 20% is very impressive, but you have a different team, so I just wanted to sort of tie in those 2 together.
So those were backup kickers that were leaving. Sorry. It was not members of the core team. So those were partners, and it's we've had very low turnover as a whole, and that our core team is intact, and this is sort of the go-forward team, and that's just, I think that's just sort of part of the nature of a venture, and I would say that, we managed one partner out who wasn't performing, and it's just, I would say that, the core team is intact, and that's our sort of our go-forward team.
Just one real quick, the geothermal opportunity in New Mexico.
Yeah.
What makes you excited about that here compared to other places that you've been?
I can tell you that.
So, most geothermal does not work well everywhere. This is traditional, and that works well in Iceland. There's rare pockets sort of in Northern California, and you actually have to go where there's a lava head near the surface, or there. But, with enhanced geothermal, as long as you have sort of a granitic rock that's sort of reasonably close to the surface, 2 miles or so, then it opens up many more geographies for their Fervo's brand of enhanced geothermal. And Nevada, and Mexico happens to have good stretches of rock that's amenable to that. Why that exists sort of geologically, historically, I don't know.
It's volcanic.
It's volcanic, yes, volcanic, yeah.
And then transmission on that, have you
So, yeah,
looked into that?
obviously transmission and interconnect is a big issue. So oftentimes the best sites are going to be near existing transmission or sort of existing plants or retired plants of other types of energy production. So you absolutely need to tie in. So you can't just go to hot rocks in the middle of nowhere with no transmission, because that obviously takes years.
We know Sunzia is over there towards the south. Sunzia project, will it extend over there towards southwestern New Mexico?
Madam Chair, Member Case, it will,
South Line Road.
yes.
There are planned transmission lines to that area, for sure, yeah.
Thank you. Great.
Also the fact that it's a priority in the state, the political climate, supply chain, that also makes it very attractive. The company is making it a big priority for future expansion. They already have existing positions, and they really want to lean in and grow significantly in the state. And it's a lot about the geology, the political climate, the market, the transmission. It's great to see good of them.
Great, thank you.
Anything further on this?
I have no questions, thanks.
Do you have a motion for us?
Sure.
Madam Chair,
Oh, yes, Chair Bingaman.
I was going to offer the motion on this, but
Do it,
I
let's
heard
do
someone
it.
else was going to beat me to it. Okay, based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $50 million to DCVC Climate Select LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, we've got a proper motion by our chairman, second by Member Summer. Any discussion on the motion before the council? Being no discussion, we will take a roll call vote.
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
9 in favor, motion passes.
Excellent. We appreciate you all for being with us today. Thank you.
Chairman, council members, thank you guys for your support. Pleasure meeting you all.
Thank you.
For the partnership. Director Lawson, do not follow that example. That's just way too long. It was exciting though. Yeah, no, it's pretty.
Now it's super exciting.
It's a new commitment.
I was going to take a moment to bask in our one basis point outperformance for the meeting.
Yay, round of applause. All right, agenda item 2C, Aries Specialty Healthcare.
Okay, thank you, Madam Chair. So in interest of brevity, I'll just bring up really a couple things. First off, I want to introduce Mary Bates from Makita with us here today, along with Douglas Peter. He is part of the I think top tier of the team that really directs how their investments are going to take place. And then we have Avni Gandhi down at the end. She is our Aries relationship director. So this is a $200 million commitment to specialty healthcare strategy. In the past, from private credit, at least as long as I've been here, what Mary and I brought to the council generally been relatively broad-based strategy. The portfolio at this point is large enough. We're going to start feathering into some more focused strategies around the edge, just to enhance our diversification over time. This is one of our first recommendations along that line. And Mr. Dieter, just as carryover from the credit committee, we had two questions that came up. I believe it was Member Tejas asked about, there is going to be a material portion of this strategy that invests in companies that are not cash flow positive yet. So I'd like you to sort of give me background on Aries. Aries is huge. What's your background?
And I promise I won't give a lecture on gene therapy here or anything like that.
If you can answer that question.
Sure.
And then, I believe it was Member Bingaman, that asked about, we'll get into it more with the Silver Rock, the size commitment to our exposure to GVs in general. And we have several exposures around the portfolio for the plan with Aries. From a policy standpoint, 10% is the max, so, you're looking at what, $2 billion that we would have to get up to hit policy. But even within fixed income, you'd have to get to over $2 billion to get within a similar size exposure. So, the plan's very large, so the dollar amount seems huge, but on a relative scale, we spent a lot of time on not just diversifying
GP strategy exposure, how the strategy is constructed, how they executed, geographic exposure. These strategies on the lending side are highly diversified underneath. There's a lot of loans in each one. It's not just one loan. So with that, I'm going to turn it over to Mary, and hopefully I didn't.
No, that was great. In the interest of time, I'm not going to discuss the strategy. I'll defer to Aries to highlight that. But as Director Lofton already articulated, this is a sector-focused private credit fund that's providing growth financing, commercial stage, specialty healthcare funds. It's targeting a net IRR of 12% plus. On an unlevered basis, we are looking to go into the unlevered share class, and we do have additional upside potential with that. So let me focus my comments exclusively on the strengths and as well as the concerns and mitigants, and defer to Aries in terms of an overview of the strategy. So what does Makita like about this strategy? We appreciate its breadth from a diversification standpoint in terms of sub-strategies. So it's a single strategy, it's a healthcare-focused strategy, but it's focused across 5 verticals. So pharma, biotech, medical strategies, medical devices, healthcare, IT, and tech-enabled services, specialty services, and tools and diagnostics. That sounds like more than 5, but how they break it out is 5. I'll let them go through that if they desire. We like also that this fund, well focused on the top of the capital structure, does have the ability to provide financing across the capital structure. We like also that it's both sponsored as well as non-sponsored. From our seat, the risk profile of this investment sits between direct lending, so you'll recall that we underwrote Golub for you, we underwrote OHA for you recently, as well as some special situation funds. It kind of fits in between that, and based on your needs, we think that this that's attractive. So 10% cash yield, give or take on this, with some upside potential associated with that. We would highlight that many of the other healthcare-focused funds in the market are focused on a single aspect of the market. So many are pharma royalty funds. There's a very, very different risk profile than this. What we like about this fund as well is there's a dedicated team of healthcare professionals, similar biographies to the gentleman that just presented with respect to the preceding fund, all very high degree, very, very knowledgeable in their respective sectors. They're also leveraging the broader capabilities of Ares. Ares, as we've shared with you before, is the largest private credit manager in the industry. They manage the largest direct lending strategy in the market. They have extensive resources, but also refer to the firm to spell that out as well. One of the things we also like about this strategy is that you're not taking blind pool risk. So meaning day one, you're investing into a portfolio where there's visibility, and that also has the benefit of an expedited deployment of capital. Given your cash flow, we want to get money in the ground quickly. So 13 portfolios, roughly $225 billion. This is $25 million. Excuse me. It's a little bit dated based on our numbers, but cash flow, no problem credit, and all roughly a 13%, I believe, yield on the program. So what do we not like? Well, what are we concerned potentially about this investment? What do we want to bring to the attention of the trust? As Tom alluded to, not all of these companies are cash flow positive. They are path to profitability companies, I think is the nomenclature that Ares uses, roughly a third of those. But they are all commercial stage, and that means there's no FDA risk. There are 2 or more products or strategies that are commercially viable, and these are growth companies. So basically, these companies are just spending a lot of money on advertising and R&D, and if they turned off those spigots, they would be cash flow positive. And Ares has done extensive underwriting, and they have visibility that within 2 years these will be cash flow positive. But again, I will defer to Ares. For public session, I won't go into the details, but long story short, they have a track record of over $1 billion in this space that has met or exceeded the return objectives. So there's a proof statement to back that up. We would highlight this as a first-time fund, and with any first-time fund, there's some representative track record risk associated with that. We would highlight, we take a lot of confidence in the fact that 2/3 of this portfolio will overlap with the Ares the business development company, which is the largest in the industry, which is the top performing BDC. I shouldn't say top, it's one, two, kind of bounces around, but one of the best performers in the industry. So we take a lot of confidence in that track record. We do recognize, again, sector-specific fund, there's always some diversification risk associated with that. We would highlight that healthcare represents 20% of U.S. GDP. So it's a massive opportunity set, and how Ares is attacking it, or investing in it, rather, I should say, as mentioned, very, very diversified. Last concern, for most managers, this wouldn't be a concern, but Ares is only managing, or only seeking to raise $1.5 billion in this strategy. Again, for a lot of managers, certainly for the previous manager that you just met, that would be an eye-popping number. But for Ares, which manages many multiples of that, it represents a small percentage of their overall assets. Whenever you have a small fund, you ask the question, is it important to the organization? Is it important to the company? How we got comfortable with that is who sits on the investment committee, and that includes the head of the BDC, the fact that 2/3 is overlapping with the BDC, and the fact, most notably, that where the $1.5 billion comes from, it's just what Ares does when they raise these sector-specific funds for the first time. And so I don't take a lot of, we're able to get comfortable with that. So with that, all of that, I'm happy to take questions, or in the interest of time, turn it over to Ares.
Mary, actually, outside of this, very specified vehicle, what is our relationship with this manager?
Sure. So, when you have an investment with Ares in the Ares Pathfinder Fund, the Pathfinder Closed-End Fund, that's a specialty lending or an asset-based lending fund. So it's a completely different team. There's no overlap on an investment perspective, and there's no overlap in terms of this team.
We also have an exposure in our real estate portfolio.
That's what I was fine with.
Ares.
Hello? Madam Chair? Madam Chair?
Yes, we hear you.
Yes. Yes, thank you. Listen, I am been at this meeting on the phone. I'd like to be recognized to vote next time.
We apologize, we did not realize that. We will call your name for this next vote, sir.
No, that's fine. No problem. Thank you.
Does that address your question? Thank you.
Yeah, I'll just pick up very quickly. Avni Gandhi, I'm the relationship manager for New Mexico SIC, and I just wanted to thank you all for your continued support of Ares as we grow the relationship with your organization. Have the pleasure of introducing you to Doug Dieter, who is the co-portfolio manager of the strategy. He's just going to walk you through at a very high level what we're looking to accomplish. He has spent his entire career in healthcare, and so really brings an extra level of expertise as we're looking to build out this specialized strategy.
But it's not going to give us a lecture on gene therapy.
He promised, so hold him to it, yes.
Yes, so thank you, Avni, and thank you for your time today. My name is Doug Dieter. I'm a partner at Ares Management. I also co-head the Ares Specialty Healthcare strategy. As Avni said, I have spent my entire career in healthcare. I have a master's and doctorate in public health, focused on health systems, and a master's in chemistry, doing a significant amount of research in laboratories prior to heading into healthcare finance about 15 years ago. As just was discussed today, Ares is the largest direct lender globally. We're also the largest healthcare private lender in the U.S. and Europe. We've invested over $50 billion with only a 0.04% loss rate since 2004. In addition, we have about 350 investment professionals across the Ares platform. On the healthcare side, we have a 12-person dedicated healthcare team with industry experience, and that's supplemented by a large advisory board that supports our origination and our diligence capabilities. We benefit from the collaboration across the global Ares platform, where we drive origination, mostly a large, wide origination funnel to increase credit selectivity while finding high-quality, fundamentally good businesses with good risk-adjusted returns. Ares Specialty Healthcare is focused on more technical, scientific areas of healthcare that requires specific expertise to evaluate and underwrite pharmaceuticals industry, the medical technologies industry, tools and diagnostics, which is actually technically one sector, and healthcare IT space, as well as specialty healthcare. Important to note, we are not focused on underwriting and investing in basic general services, as they tend to be less differentiated businesses to underwrite. Our subsectors offer diversification and are defensive and non-correlated with thousands of companies across the U.S. and Europe. These companies are benefiting from long-term tailwinds, including the aging population and increased investments in R&D. Over the past 5 years, the Ares Specialty Healthcare team, we've invested $13 billion of specialty healthcare capital with a 0% loss rate and have generated a premium to the overall market. As it relates to the actual Ares Specialty Healthcare Fund, as was just mentioned, we already have an existing portfolio of $225 million across 13 portfolio companies. And we believe that the demand for specialty healthcare credit finance is going to be robust long-term, as there is an increased need to invest in R&D, M&A, and commercialization efforts. It's also really important to be a really good partner in the space. We appreciate your time and attention here. And maybe I'll address the first question that Tom mentioned. And he mentioned that, a certain percentage of these businesses will be negative EBITDA at the start of our investment. There is a very large universe of companies, in particularly the life sciences space, and we define that as pharmaceuticals, medical technologies, and tools and diagnostics, that are commercial stage, have large market caps, have diversified products and services, but they're investing heavily in commercialization and R&D. Typical company may have 3 or 4 or 5 drugs approved, but they have multiple clinical trials that are global in size and scale, and they're important in time. And as a result, the businesses have higher R&D budgets than their revenues, but we view those as underwritable because, one, we're only investing at the top of the capital stack. We're first lien on those companies typically, and they're typically lower loan to value. We're also, as Mary mentioned, underwriting these businesses that they need to be profitable within a couple of years.
Madam Chair, I think this message is for Mary or Tom. Question. On the ones that the chairwoman was talking about with the Pathfinder and the real estate, what contributions were those? Was it $250 or $500?
The Pathfinder was $300. And I'm not sure on real estate.
The last real estate fund that was last meeting was 200 million euros, but we have like 5 or 6 funds with Ares and other accounts.
Yeah, okay. I just was curious because though it's very different, it's overall the same.
It is. It's a valid concern on a number of levels. One, certainly, it is with one firm, and we've seen there's one in the news recently where, a piece of news can come out and really hurt their reputation, hurt their, we got comfortable with this in a couple ways. Number one, as Mary mentioned, Ares is exceptionally large, global institution. There's going to have to be for Ares as a whole to have something happen that's really detrimental to their ongoing viability. It would have to be pretty serious across multiple fronts. That's one thing. The other thing is the Pathfinder strategy is very, very different from this strategy. The Pathfinder strategy is a collateralized strategy. You lend based on you're collateralized by something. This is more of a cash flow lending, where you've got corporations and you're lending against their future prospects, as opposed to something directly collateralized. So just on a couple of, on a couple of places where we're differentiated. But it's a valid point, and it's something that we are very conscious of. And there you can pop in whatever you want, but we put a lot of thought into how many relationships we want to have on both a strategic as well as a tactical level. And frankly, Ares falls into more of the strategic level, given their size, given their sophistication, given their depth. given just the wide range of strategies under one roof that you can go into.
I do have concern because it's over $1 billion of our $58 billion that we have in areas in total. I get that they're the biggest, and with that comes a lot of expertise. But when I'm looking at diversification in totality, there is diversification within the areas funds that we've applied to, but, applied our money to. But I still know there's a lot more in the realm of each of those markets that we could also be looking at that might not be as big, that would have to be smaller amounts, but that could also diversify that portfolio. Dr. and Madam Chair, I would just ask, is there a page of what the team looks like? Usually we get that in our packet. I decided it's a smaller packet for Aries, so I'm just wondering if you guys have it.
Yeah, so that's, Madam Chair, that's my fault. I asked Aries to pare down their presentation, to keep it relatively brief. They have a 13-member team. I don't know if the team has grown any, but,
No, it's the same size team. If you're asking around, if we're focused on diversity, and we have a chief diversity officer. It is a major focus of the organization, and our team is equally reflecting that.
I think for me, that's important. I know they want to trim down the meetings, but for me, I want to see the full package, even if I take it home and I read it between last week and this week, or this week and next week. Especially when we've already invested over $1 billion, that is important to me. How much are we putting back towards New Mexico or New Mexicans? We have internships with you guys. Is there ways that somehow the money that we're investing out is somehow coming back other than just the rate of return? And then also it's a new relationship, so, there's nothing to identify what that rate of return was in the past to today, but I feel like we're putting a lot more, wordsmithing, we're putting a lot more skin in the game, in a new commitment than what I feel like a commitment, like, you know, there should be skin from him as much as from me. And I'm not feeling that that's happening a lot in a lot of the things that we're adding new relationships to.
Understood.
Knows my language.
Yeah, understood, and Mary spoke a little bit about the fact that we were able to get comfortable with the fact that this is a new strategy, new focus strategy. It's really not a new strategy with Aries. They've been doing this for a long time, and when I say this, I mean lending to the healthcare sector in general. Excellent track record. Now they just decided to create a focus team that really is going to focus within Aries to do that. So that's how we became comfortable with it from that standpoint. I apologize for the fact that I don't have all the team members. You know, if I can go off track just a little bit, as far as ESG, diversity, that's one thing that Nikita, they focus on in all of their due diligence reports, and happy to have that. They're very consistent about that. And certainly, you know, I'll let, if you want to expand here on any as far as.
I think what maybe, it may not be directly relevant for this strategy, but one of the key initiatives that Aries Pathfinder has, and I believe we profiled it when we did the commitment, was the charity tie-in. I don't know, do you want to highlight that?
Yeah, so a portion of the carry that Aries earns within our Pathfinder and Pathfinder core strategies, which is than this one, but SIC is committed to both the global health and education initiatives. And that's something that we believe in strongly, particularly the co-heads of those businesses, and has generated millions of dollars of contributions and donations to various organizations around the world as well as here in the U.S. So I do think it is a focus of Aries to ensure that we're always giving back to the communities in which that we operate.
And that's wonderful. How much of that money came to New Mexico?
Well, I will tell you that of the business we invest, quite a few of them provide care to patients in New Mexico. I don't have that data. I'm happy to
track that and provide that to you, but I can assure you that, oncology care, maternal health care, many of the businesses we invest in are operating in New Mexico as the largest healthcare provider lender in the United States.
So that's part of what I would like to see in the packet is, especially if determination of skin in the game can be different ways, right? That's one of the ways in which bringing something back into New Mexico, especially for investing over $1 billion of our taxpayer dollars to this relationship. It's important for us to also know how is that contribution also coming back other than rate of return, because it can in simple little ways that add up to a significant idea of healthcare or climate or job force, whatever it is. I mean, it all adds into a better New Mexico. So thank you very much. Anything further? Mr. Chairman, do we have a motion?
Madam Chair, thank you. I'll go ahead with that. Based on the recommendations of the Council Investment Committee, Consultant Makita, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $200 million to Ares Specialty Healthcare Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Great, we've got a motion by Chairman Bingaman, second by Member Summer. Any discussion on the motion before the council? Seeing no discussion, we could take a roll call vote and make sure that we call on Member Makita.
Yeah. Commissioner Stephanie Garcia Richard. Yes. Treasurer Lauren Montoya.
Yes.
DFA Secretary Wayne Probst. Nick Tejas. Yes. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Summer.
Yes.
That's 10 votes in favor. Motion passes.
Great. Thank you all so much.
Thank you. Thank you so much.
Thank you.
Thank you. So these next two are what we call add-on commitments. These were commitments that were previously approved by the council. Since we've had so much, you've seen a few of these lately, but we've had so much growth in AUM as we think about what the appropriate commitment level should have been. We're quote-unquote topping them up or adding them on. This is the Silver Rock Lobo Fund. They let me name it Lobo just because this is essentially a fund of one for SIC. This is a $150 million top off to raise the total commitment to Silver Rock to $450 million. One focuses on distressed credit, private financing, specialty lending. I think the net IRRs, the range is 11 to 15%. So Nikita, Mary's team underwrote the first commitment, so for this add-on, I've not asked them to do an additional, a repeat due diligence. I think we have Andrea Boyke on the line from Silver Rock if there are any questions, but with that, I'm going to turn it over to Mary.
Great, I will keep my comments very, very brief. Makita presented the initial commitment to the SIC in April of 2023, and at that time provided a comprehensive underwriting. Silver Rock is executing that strategy consistent with that underwriting. As a very brief recap, Silver Rock employs a capital solutions strategy in Lobo, which is a fund of one vehicle. They're targeting a net IRR of 12 to 15% with a 1.4 multiple on invested capital. The GP has the flexibility to deploy capital across all phases of the credit cycle in this strategy, as well as opportunistically capitalize on dislocations in the publicly traded markets. That's one of the reasons that we like this strategy quite a bit. The majority of the capital is expected to be deployed in capital into deals directly originated by Silver Rock to companies both sponsored as well as non-sponsored. Consistent with the flexibility of the capital stack, the use of proceeds vary. The majority of the return is expected to be generated through yields, with select yields, offering upside, no fund level, leverage is utilized. Since being, retained, Silver Rock has deployed roughly a third of the capital through the end of February across 9 investments. The yield on the portfolio is 14.5%, with 100% of these yields offering, upside. One of the things that I do want to draw to the attention of Treasurer Montoya, given the comments earlier, this is a minority and women-owned entity. I'm sure Andrea and Vinay would be happy to highlight that in further detail. So similar to recent recommendations across multiple asset classes, we were recommending an increase in the mandate consistent with the increase in annual commitments. Happy to take any additional questions or any questions. Or turn it over to Andrea and
Vinay. And Vinay, I apologize, I didn't realize you were going to join us.
Yeah, with an emphasis on special situations.
There you go.
Super broad. Like, what they do is cap solutions, so they directly originate debt to companies for like growth financing, for rescue financing, for project financing, for a whole range of deals. They have some flexibility to do distress. It's a very, very small percentage.
Sure.
There we go.
Andrea, can you hear us?
Yes, I can hear you. I was just waiting to see if there were any questions. We thank you very much for the opportunity to have you consider a top-off investment into the Lobo Fund. As Tom and Mary had suggested, the strategy is performing well. We are about a third committed. Vinay Kumar, who leads the strategy as the head of private credit for us, is on the call as well. We could discuss the environment and the pipeline, but really wanted to just emphasize how much we appreciate our partnership with New Mexico.
And just for the record, I instructed the Silver Rock people to not really give a presentation, but be there to answer questions. Same thing for ACOR that's going to be next.
Are there questions?
Just one question.
Yes.
Real quick, just reading on the manager overview, it says that the firm manages a broad range of credit strategies, so forth and so on, but it talks about collateralized loan obligations, CLO. What can you tell me about that? I mean, that sounds a lot like way back when, collateralized debt obligations.
So that's a separate business line for the manager. You're not invested in their CLO strategies, but it is like Ares, like all managers offer different strategies and different funds. So they work with some clients who they manage CLOs on behalf of, but that's not part of your strategy.
Okay, not part of our strategy manager, but we invest in them and it affects their financial health and things like that.
And member Tejas, we have exposure to CLOs elsewhere within both public and private fixed income. And just very broadly, and I hope this doesn't come across wrong, but just like investing in a company, whether you want to be in the senior jet, the junior lien, preferred equity, same thing holds for a CLO. Senior tranches versus the junior tranche versus the equity tranche. And all of that can have a wide risk profile range. In addition, what's the underlying mix of loans underneath? So, yes, just for full disclosure, we are exposed to CLOs elsewhere, and I'm happy to break that out at some point in the future if we need to.
Yeah, not to belabor, Madam Chair, but you and Mr. Clark and team, maybe if we could have a presentation on that sort of strategy with, collateralized debt obligations, and mortgage-backed securities, and what's going on with the current economy now, and how we're perhaps, involved with some of those things. I just would like to kind of know, just to make sure that we're not entering into risks that, are repeated from, way back when. And I'm sure we're not, but you know how it goes.
years ago, there was a problematic investment with a allegedly subpar manager in CDO equity, which was the riskiest in a collateralized different structure. I think the issue there was more the quality of the manager, also the equity tranche, the highest level of risk within that type of debt structure. I just want to assure the council today this is nothing like that. And CDOs and CLO products are really standard in.
And nowhere in public or private debt do we invest in the equity tranches. We're in the senior tranches.
Yeah, and on that point, if we could just maybe eventually, when we have time, I don't know if we ever will, but I think it's important for us to know where that kind of lies, that, maybe even regulations that have been, put in place to, fix those issues that happened years and years ago. Maybe there's not a lot of regulations, but.
No, it's just, it has, the issues that happen there was a different risk thing, with a different type of manager, with a different political overtones to,
Yeah, there's
nothing.
manager, there's that, but there's also the whole subprime mortgage lending issue where you collateralize debt and then you.
And post GFC, and frankly, I'm old enough to have been right in the middle of that. And post GFC, there with these structures, and it's what the rating agencies required when they rated senior tranches and things like that. There was a 1.0 and there was a 2.0, and the 2.0 being the diversification requirements, the underlying equity requirements and structure tightened significantly versus pre-08. So yes, there have been some improvement in the structures in general, but to your point, yeah, we're happy to go into.
Again, I'll just recommend that we continue the golf line.
It's not part of the
Directly in front.
Yeah. Thank you.
Quick question. Madam Chair, I know that out of the 300 million, it was mentioned only half of it has actually been, thank you, deployed. So it might be too early to ask, but based off of what you think the IRR is, are you leading in that direction, or do you feel that you are moving nicely in that realm of what your expectation was?
As we highlighted, the manager's returns are in line with the expectation for this fund. Vinay can go into detail around it, but you're targeting a 12 to 15% net. The manager is exactly hitting those return expectations.
That's wonderful to hear in the first year, and I will point out, because I'm the one who always points out otherwise, that 55% of women and or ethnically diverse employees are owned in here. I don't see the pictures on these papers, and I really appreciate when we do see them. Do you have any comments to mention of how you got to that point, or how did this happen? Because it's not usual that we read.
No, we thank you for the opportunity to speak to that. It is actually very broadly diversified. So we have a nearly 50-person organization. We have 14 partners. And as you note from the comments on the write-up, it's very broadly diversified in terms of how many people on our investment committee, how many people are rather on our investment team. So 50 are women and minority, 50%. On top of that, around 65% of the employees in general are women and minority, and the ownership is very broadly dispersed as well across those 14 partners, with 55% being owned by women and minorities.
Madam Chair, but my question is, how'd you get to that point?
Oh, I think we hire really great people, to be honest with you. It wasn't by design, it was by hiring talented individuals since we began as an organization in 2010. The turnover is incredibly low at our organization. We have brought in individuals that we think have been the most talented, and consequently, this is the blend that we have.
Based on the recommendations of the Council Investment Committee, Consultant Makita, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of an additional $150 million to Silver Rock Mobile Fund Series 23 Tactical Allocation Strategy, subject to contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, we've got a motion motion by the treasurer, a second by member Tejas. Any discussion on the motion before the council? Seeing no discussion, if we could take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Probst, Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell, Alan Sancho,
Yes.
Mike Messina,
Yes.
Kurt Summer.
Yes.
10 in favor, motion passes.
Great, we thank you folks for being on with us today. Thank you so much.
Thank you. Thank you for the partnership.
All right, this is our final investment vote, and if all of you can do what you can to, help target, at least by 2, if not before, end date for our, end time for our meeting, that'd be great. Okay, so April.
So joining me on this is Reggie Ross from Nikita, I believe we have Mike Romo from ACOR on the line. So this is another quote-unquote top-off / add-on commitment of a prior approved commitment. The recommendation is for an additional $100 million to this strategy for a total exposure of $250 million with this fund. This fund focuses on real estate debt. Since Nikita did not underwrite the first commitment approval, they did a new underwrite for this commitment add-on. Reggie Ross is on the line to speak to that. And Reggie, do you have any comments?
Just very brief. Thanks, Director Lofton. Good afternoon, everyone. As Director Lofton mentioned, Nikita undertook a full underwriting of the strategy. And the only other comments that I'd add are we're very supportive of the strategy, very supportive of the team. We actually are coincidentally more supportive of the strategy now, given where interest rates are, than we would have been at the time of the original underwriting. So very supportive of the recommendation. And with that, happy to answer any questions from the committee.
Any questions? Hearing none, do we have a motion? Actually, yes, I'm trying to figure out how to say it correctly. Madam Chair, can you explain a little bit about any of the concerns you may have had regarding conflict of interest? Or if there's any concerns that you may have had?
Sure. I think, is that for me, Madam Treasurer?
Yes.
Sure. I think in Warren DeHaan and Mike Romo from ACOR are also on the line, but from my standpoint, I think anytime you have a fund manager that has multiple investment accounts, that's always something you want to look into just to make sure that the investment that you are going into gets a fair allocation of investment opportunities, and that there is a very well-defined and closely followed process for rotating investment opportunities to the extent that there are other competing accounts that the manager is overseeing that could also have some of those investment opportunities. We took a very close look at that. We're satisfied with ACOR's rotation policy. Mr. DeHaan or Mr. Romo can add further remarks to that, but that is something that we look at very closely, Madam Treasurer, anytime we're dealing with a manager that has multiple accounts.
If that's satisfactory, this is Warren. I'm the CEO and co-founder of the company. It's nice to see everyone today, and thank you for this privilege of being here again in front of you. We take allocation and our separate accounts and the accounts very seriously. Our allocation committee is independent of all the investment professionals, me included, and it has been thoroughly audited by Nikita and other advisors and consultants, and heretofore we haven't run into any issue with it.
We appreciate that, sir. Thank you. Anything further?
I'd just like to quickly comment, in addition to the fact that as part of the investment due diligence, we look at the allocation policy that's something that separately our legal counsel also looks into as part of the legal due diligence as well.
Do you have a motion?
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Nikita, SIC staff, and General Fiduciary Oversight of RBK, move that the SIC State Investment Council approve a commitment of an additional $100 million to ACOR Credit Partners II, subject to a contingent upon the municipal legal requirements, Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst. Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Sommer.
Yes.
10 in favor, motion passes.
All right, thank you to the ACOR folks online for being with us. Mr. Ross from Nikita, thank you. And Ms. Mary.
Thank you very much.
Yes, thank you.
All right, next, I believe we've got contemplation of a benchmark change. We're going to turn it back over to Mr. Lawson.
Thank you, Madam Chair. This is, public debt portfolio related. Essentially what happened here, on the administrative side, SIC decided to, subscribe to a different family of indices. So there are multiple quote-unquote families out there. There's the Bloomberg family, there's the Bank of America family, and so on. SIC decided to, subscribe, to the Bloomberg family of indices. So at that point, we went to RBK, which is our consultant on the public fund side, and from RBK, I have Matt Sturz at Zaglin joining me. We went to them, we went to the manager, we said, okay, within the Bloomberg family of indices, what is a comparable benchmark to the one that you currently have within the ICE indices? And this is just to adjust to, these benchmark changes are to adjust to the changes in the family. There's no change to the spirit of the underlying strategy, which was originally recommended to the council.
Madam Chair, why did we do this? Is it a cost?
It was a cost issue. Yeah.
Yeah, we've seen that in other books. So is it now free for you guys if you change it?
It's not free, but we subscribe to the entire family. And in order for RBK to use indices for performance and actually publish that, we have to subscribe to the entire, we have to subscribe to the family of indices.
Would it be fair to say, Madam Chair, all of our benchmarks would be within that same family for everything?
Yes.
Got it.
They would be, and because we included the benchmark in the investment management agreement, for these two funds, we needed to bring this back to the council.
I'll set that. Based on the recommendations of the Council Investment Committee, Consultant RBK, and SIC staff, I move that the State Investment Council approve changing the benchmark providers for the short duration credit strategy and the Alliance Bernstein High Liquidity Short Duration High Yield Strategy to new Bloomberg benchmarks as detailed and memorialized in today's meeting materials as discussed by the council.
Second.
Motion by the treasurer, second by Mr. Tejas. Any discussion? There's no extra cost, correct?
No.
Got it. Hearing no discussion other than that, we will take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst. Nick Tejas.
Yes.
Catherine Allen.
Sorry, yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Summer. Yes. 10 in favor, motion passes.
All right, great, thank you so much. Thank you. All right, next we have what is called a consultant real life. We are consolidating responsibilities, real assets portfolio with Mercer.
Madam Chair, I can make that pitch in 10 sentences.
Great, Director Taylor.
We're recommending consolidating responsibility for the real assets portfolio with Mercer. Due to the evolution of private equity and real assets investments over time, SIC has maintained two consultant relationships within the asset class. Having separate coverage in some portions of that sector and overlapping coverage in others has been coupled with increases in pacing, has increased the burden required to coordinate between both of those two consulting firms. Key advantages of this action would be to streamline the investment process, enable staff to better optimize the strengths of each of the respective consulting relationships, and to simplify the assignment of roles in what we expect will be a growing real estate and real assets team. From a financial perspective, there will be no net financial impact to the SIC. Finally, I add both of our consultants are supportive of this decision, and we highly value each firm's past contributions and appreciate their willingness to help us accommodate our growth.
Madam Chair, who's the other consultant?
Townsend?
So they both have agreed for Mercer to take over, and how does that change on cost?
There is no impact.
I see that it says no financial cost, but I think it doesn't register in my brain how that works then.
Okay, so
then there should be less cost to us on one end.
no. So the existing real assets contract is bifurcated for, well, actually, I should say the consulting contract with Townsend is bifurcated, such that there's a real estate piece and a real assets piece, and we're just moving the real assets piece.
Townsend will only be doing this
They will only do real estate going forward.
for the same amount of money. Yeah, because it's RFP
No,
consultant,
no,
it's the same dollar
yeah.
amount.
Now, let me go through this again slowly. So the real estate contract, for the Townsend contract, has a real estate component and a real asset component.
For X amount of money.
Exactly. Each one separately, right? And so we're going to move the real assets piece of that over to Mercer. And so the contract value will remain the same. The person providing the coverage will be different.
So you're saying that the dollar amount that Townsend was getting for real assets will be the dollar amount that Mercer will get instead?
That's correct. The nuance there is there's a CPI indexation in that contract. So if you were to compare last year to the year going forward, the difference would be inflation.
And they're both willing to do an addendum to their contracts to be able to do this change, which also includes that Mercer just got their updated contract, and they also got a new fee for the co-investment portion as well, correct?
That is correct.
Thank you. Okay, anything more? Motion.
Madam Chair, based on the recommendations of the Council Investment Committee, SIC staff and general fiduciary oversight of RBK, I move that the State Investment Council approve consolidating responsibility for the real assets portfolio with Mercer, subject to and contingent upon New Mexico legal requirements, Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate changes.
All right, we've got a motion by Member Tejas, and second by Member O'Donnell. Any further discussion? Hearing none, we'll take your roll call vote.
Commissioner Stephanie Garcia Richards. Treasurer Laura Montoya.
No.
CFA Secretary Wayne Probst. Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Summer.
Yes.
That's 9 in favor. Motion passes.
Okay, next we will hear, I think for the first time in our meeting, Chavez Romero,
And Madam Chair and council members, I apologize. I did not realize that we inadvertently left off Secretary Wayne Fox's name off of this as well. We had intended to have so Tim Manning and Amy Chavez-Romero, listed on this item.
Very good. So we're gonna hear from Amy and Mr. Secretary on contract delegation and reporting resolution.
Madam Chair and members of the council, on page 380 of your diligent materials, you will find a proposed resolution to allow the State Investment Office staff to approve, terminate, or amend contracts above $50,000. Currently, the State Investment Office staff is approving contracts up to $50,000. The council would retain the authority to approve contracts for which authority is otherwise reserved to the SIC by law or policy. The resolution would also require the CFO to provide quarterly reports of all contracts exceeding $250,000 that are approved, terminated, or amended.
So what you're saying is there now is, so
Madam Chair,
it was up to, and now it's,
I think it's a limitation of 50K, so I'm reading.
What the policy would allow is for the State Investment Office staff to approve contracts of any amount. So before there was, they could only approve contracts up to $50,000, and now they'll approve contracts beyond $50,000 as well.
well, let's hear from Mr. Secretary.
Madam Chair and members of the council, that covers it, obviously. I believe, and I'll be corrected if I'm wrong, back in the fall, I think it was actually Member Sommer, we had a contract for $50,000 come before the council for approval, and I think he asked why. I think this is an outgrowth of that. Obviously, the council has changed a lot over the years. I like to think that we're ready to take some of the training wheels off, and this is one of those. I think we really trust our new chief investment officer and his staff to not only approve contracts and monitor those, but also report back to the council on a regular basis, which this bill requires. So, Madam Chair, I think this is a good evolutionary step for the council to take.
Madam Chair, do we have a listing of what contracts we have under SIC and what the dollar threshold has been for those contracts? Because I know some of them are very significant in the dollar amount that we utilize, and a lot of them are the people that really are important for us, like Makita and Mercer and Townsend.
Yeah, I can speak to that, Madam Treasurer. So this change would not give up the SIC's power to approve those contracts. So under statute, the State Investment Council has the authority reserved to approve contracts for investment consultants, investment managers, and there are other things under statute that the State Investment Council would retain the power to approve. So the State Investment Council wouldn't be giving up authority to approve contracts for which power is otherwise reserved to you under statute or policy.
And Madam Chair, my question would be, what authority are we giving up then? What contracts would this include, and up to what dollar threshold have they been currently?
Yes, so it's my understanding that in 2010, the State Investment Council started approving all contracts over $50,000. And it has been, it is the recommendation that the staff also be allowed to approve contracts over $50,000 if there isn't power otherwise reserved to the council for specific kinds of contracts. So those would include investment consulting contracts, investment manager contracts, contracts that pertain to litigation expenses based on a contingent fee basis, custodian bank contracts. So if there's not something that is reserved to the State Investment Council by policy, this resolution simply clarifies that the State Investment Council staff would have the authority to approve those other contracts.
I think what you're asking for is what kind of stuff is this? It's like information services, like, I would think the Rystad Energy that you saw.
Oxford Economics.
Oxford Economics, maybe a lease.
you know, things that are not as critical arguably to the investment operations and the fiduciary stuff that you oversee.
Yes, Madam Chair and members of the council, it would be contracts related to the daily operations of the staff. It wouldn't take away from your power at all to hire consultants to advise you or managers to bring us these projects. That still is retained entirely by you.
Madam Chair, I think this was good, Evan. In that, what was the max dollar amount that you see on the operational side of those contracts?
I'm gonna look at Brent on that one. Give us an idea, I'm within your categories, like what?
What's the question?
How much might we spend on a big information provider or a lease type thing, or, you know, what's sort of the dollar?
We're considering something right now, it hasn't been fully vetted on the IT side, probably about $200,000. So that gives you some sort of idea. And I know in the past, as Secretary Probst has said, we've brought leases, other things like that probably wouldn't have to address in the future at the council level.
Anything further?
Just, Madam Chair?
Yep.
Is there a provision in there that states that if we authorize this policy, that we'll still be, and staff will still be subject to New Mexico's statutes and other laws and those sorts of things? Is that in that policy anywhere?
Member Tejas, no, it's not specifically stated in the policy, but it goes without saying that, the staff would still be subject to the statute.
So, Madam Chair, also, a lot of the things that we enter into are exempt from the procurement code. I mean, every time something comes up, I ask Evan, and investment related, yes. However, I do still, want us to make sure that we're following the procurement code when needed, obviously.
We will do our absolute best to follow all laws, regulations, policies, and any other good sense that comes with anything, any sort of, because by the way, staff is a fiduciary too, in our statute, so we're as tied in as y'all are.
Hold on,
Madam Chair and, Member Tays, one example coming up is, I want to review the website. That is not investment related, so I would go out to RFP to like any state agency.
Okay.
I would say I'll make a motion to approve anything under $200,000, that is operational, that goes through your guys' procurement process to be handled through SIC and reported back to the SIC on a quarterly basis. I don't know how often you guys want to do it. And that has nothing to do with our statutory responsibilities on the investment side or anything else related to the statute that Amy mentioned.
Madam Chair, I would consider that to be an unfriendly amendment to the motion I was going to make.
The only piece of information I might add that might be helpful is we took the framework of what the council wanted as a policy. This wasn't like creative drafting. We really tried to stay within the framework of existing policies. So what you have in there is the updates to the policy that we've been operating under, that you wanted us under, I don't know, the last 15 years or so. So that's why it's sort of written as is, because we stayed within the existing framework.
Madam Chair, but can we have a threshold on 200? It seems reasonable in terms of reporting back.
Well, reporting back is the 250. That's the reporting back. Quarterly?
Okay. Yeah, I'm good with that.
That's a nice, balance.
And Madam Chair and council members, I would just also say this is still more transparent, more accountability than other state agencies. For example, at the Economic Development Department, I was able to approve contracts of any size with no external reporting at all. So I could approve a $2 million contract, and there was no external reporting required beyond just following the procurement code.
And on this motion or on this paper, I don't see anything. Okay, otherwise, by law. Very different from that. That probably looks a lot more than I would do. Yeah, that's different from what's in front of us.
That's the whole thing.
No, that's just, that whole thing is different.
Resolution in front.
Page 380. Yeah, that's the resolution, this is the motion, for the resolution. With the resolution as memorialized in today's meeting.
Yeah. Ready?
But do we have a motion on the floor?
We are about to have one, like.
I thought she made a motion.
In
I thought
10
she made a
seconds.
She didn't get a
I didn't get a second.
Can you second that? Madam Chair, I move that the State Investment Council approve the resolution for staff contract approval authority and related reporting as memorialized in today's meeting material and as discussed by the council.
Second.
All right, we've got a proper motion by the secretary, we've got a double second by, Member O'Donnell and Member Summer, but we're just gonna wait and see if there's any discussion on that.
My only question would be, does that mean that any contract under 250 the council would not know about because it's only those that are in excess of 250?
Madam Chair and, Madam Treasurer, if there was anything that was below that amount that still seemed, like it was worthy of bringing to your attention, I would ensure that was still included. If it was a routine information service like Oxford Economics or ISAT, no, I would not bring that.
So, Madam Chair, on that point, so we're talking about an audit contract, would that come to us as well? Or would
I think an audit contract would by its very nature.
Well, and it goes to the committee.
Yeah, well, I don't know, I mean, if we authorize this, I'm just wondering, does that?
That's a good question, but I think it would.
Madam Chair and Member Tays, I believe the charter for the audit committee requires that the audit committee be in charge of that. So that's nothing that can be changed even through change in council policy today. You would have to go in and change the charter to make that change.
So let's just clarify that there are a number of items that require council approval that are not designated. We're saying,
I think for me, Madam Chair, I don't have a problem with giving staff the 250,000 threshold. I think for me, it's more of a transparency to have it in the report, like that Mr. Shipp puts at the back, where it just shows everything that we've paid out. That's just part of like a reference, like the way we do on our treasury kind of thing. So it's not, I don't have an issue with you guys doing your operational stuff for 250 or lower. It's more of just being aware of what it is so that when we're talking to people, guys, oh yeah, we use them as a consultant for this, or we researched this through this economics, whatever. Having more information for me is better, but that's the only thing that I would support.
okay, anyone else? Okay, we can take a roll call vote, and can you start with Member O'Donnell? Yes.
Okay, thank you. Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Pass.
CFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Summer.
Yes.
That's 9 in favor, motion passes.
Oh, no, I passed.
I think I took you off. There's still 9. 1, 2,
So
3,
pass,
4,
you gotta
5.
come back to me.
Oh, I'm sorry. All right.
Yes,
Okay, all right.
because I'm a secretary prop.
All right. Thank you.
And I'm wondering, so thank you so much, thank you for all the work that was an important piece, of our puzzle. I'm wondering, we've got the legislative review in front of us.
If there's any questions,
Are there questions on the legislative review?
Only one question.
Yes.
Only because we followed it, tracked it on the legislature, the, tribal, educational trust fund. A question, would that come to State Investment Council?
It would have, it was one that we were actively tracking, but, of course, that bill did not pass. This is the second time that, a bill was introduced that included us as managing that fund, so it's definitely on our radar, should it come back again.
Thank you.
All right, let's move now to agenda item 3J, council committee appointments. And we'll start with, who's gonna do that?
Madam Chair, just, I'll start, by letting you all know who is currently on the committee. So we have, 3 committees. We've, got the governance committee made up of members Allen, Sommer, and Messina. We have the audit committee made up of member Tejas. And there, in some cases, there are also advisory non-council members on these committees, just listing the council members. And then on the investment committee, we have members, Bingaman, Tejas, and Messina. So, there is some room to add members. I would say particularly to the audit committee, if anyone is interested in joining member Tejas on that. And unfortunately, yeah, member O'Donnell left, but, in discussion with Madam Treasurer, we thought it would be a good idea to bring this to the council, for new members to potentially be appointed, and in particular to see if either of the new members were interested, but also anyone else who's on the council.
Did she share with you what she?
No, I did not realize she was not going to be able to stay for the site.
Can we ask her to what she wants to be on, and you just talk to her about it?
I'm happy to do that.
And
Yeah, I'm interested in the governance committee.
And I'm also interested in the governance committee, in particular now that we have so much work that's going to it, including the revamp of the investment policy, so I would like to do that. So can we have a, you like that, can we have that?
Yeah, so Madam Chair, there shouldn't be any problem with having up to 5 council members on there. It does mean we will need to be a little bit more cautious about what visiting council members we have attend some of these meetings, but there's no problem with having up to 5. And historically, the council has just voted to confirm these appointments.
Is there anyone online that wants to be on anything? I can say both Bingaman's the chairman now, and Kathy's the chairman of
Governance.
and Messina is in the investment.
Messina's an investment and government.
He's retired. Do you all have any, different desires for serving on committees? Would you like to be taken off or put on any additional? Kathy Allen?
I like being chair and I like being on governance, so that's where I'd like to stay.
John Bingaman?
I'm fine with my current commitments. Thanks, Madam Chair.
Mike Messina? Wait. Mike Messina?
Yeah, I'm on governance and the investment committee, and I like that, but I might add that my term ends in April, so as soon as my replacement is named, I will no longer be on the council or the committee.
Good to know. Thank you for that reminder.
Madam Chair,
Add to that real quick.
I'm happy to serve on the audit committee with.
Oh, are you? Wow. Yay.
Hey, I'm happy with that.
We will not take that motion. So, may I make a motion to have on the governance committee, member Ellen, member Summers, member Messina? Well, we're just gonna add, yeah, can we make a motion to add member Sanchez and the treasurer to the governance committee? Add the secretary to the audit committee? And then, can we say, member O'Donnell to a committee of her choice, as long as it doesn't already have 6?
That sounds perfect, Madam Chair.
So moved.
Second.
All right. Any, discussion, any objections? So moved. We're just gonna do, we can't do that, extra motion and there's 3 on sorry. All right, quick roll call vote on that motion. Quick. Sorry about that, man.
Sure. Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Alan Sanchez,
Yes.
Mike Messina,
Yes.
Kurt Summer.
Yes.
9 in favor, motion passes.
Excellent. All right, Brett, we are ready for you, sir.
Sure, and Madam Chair, I'll be super brief. Just wanted to remind everyone that on item number 3 here, agreed upon procedures, there is a deadline of March 31st to have those reports finalized, so those will be sent out to everyone around that time. I know last meeting, Treasurer Montoya mentioned maybe some changes to the budget template. We're looking into that. It's a template that we got from DFA. I want to reach out to them and see if there's any input that they might have. And then Treasurer Montoya mentioned earlier, she's on a lot of boards. I just wanted to point out within the investment holdings report, you can see every month and every quarter all the client activity. And if you ever look at that client activity and have any questions that we can help you with, please reach out. Another thing that came up in the meeting earlier today were the fees for both private and public assets. I just wanted to point out as part of the audit report, I think it's page 72 in the back of that report, we do disclose all of the fees and carried interest on an annual basis. Not all of those are audited because of the timing of accumulating that information, but if you go to the audit report, I think you'll find those. I just realized that the template that we have to follow is something that LFC has provided, and it's not all that easy to follow. So if you have any questions there, we're happy to help you with that. And then finally, I wanted to mention, because this came up since the last meeting, there was supposed to be an audit rules hearing on March 13th. I signed up to go to that hearing. The hot topic on the agenda for that audit rules hearing was a change in the audit rotation requirement from 8 years back to 6 years. And I think DFA, the controller, state controller, provided input. I provided input. After input from both myself and Mark Melhoff and others around the state, I think it was decided to cancel that meeting, and the rotation requirement stays at 8 years for the time being. With that said, I think I talked to Member Tejas earlier. We're probably going to postpone the April Audit Committee meeting because we're going to go out to bid. You timed it perfectly. We're going to go out to bid for the last 2 years of an 8-year term. We probably could squeak by this year with one additional year, but we're going to have kind of a lagging 1 year. So we're going to, currently we're working on an RFP for the final 2 years. It's very likely that it'll be with Moss Adams, our current auditors, but just wanted everybody to be aware of that. And I'm happy to entertain any questions that anybody has.
CFO. Accolades. Criticism. Great, thank you so much.
Sure.
Any old or new business before the council? Yes.
New business, yeah. So, it's gonna take a couple of minutes, but we'll get through this. I want to express, on my behalf, not the whole council, but I'm sure the council feels the same, the tremendous work that the investment office staff does, and just hearing how we're going to explode. This fund is gonna double. It's projected in the next 10 years. And the vacancies have to be filled, and we gotta have a retention. We gotta keep these wonderful people, and we need that historical memory, that living historical memory in the organization. And so, in 3 parts that I want to say. Number one, I encourage Mr. Clark to do a very good review and understanding of our compensation of the staff. If we're going to keep these people, we have to show our appreciation. And we're really not compensated for hours. They're not a renewable source. Once you've used that hour in your life, it's gone. And with a $53 billion fund headed to $100 billion, the stress level there, we can't really compensate you for that. Because I don't know how many years off your life you're losing because of the stress level. But in that, there has to be a fair, true compensation. So if you'll continue to do that with with looking at all your staff and what's the fair, I would like to ask for, Mr. Clark, if you would direct your staff to do some research and put the data together and report back to us in May on what are the peer funds, what are the compensations for the leadership in the peer funds that are competing with us to steal our wonderful employees after they go through this experience and understanding who we are, not just as a fund, but one of our greatest assets are the people and who you're serving to. This Sovereign Wealth Fund, this fund is a prosperity fund. And so it has to help the people of New Mexico be prosperous, but we also have to know that our staff are. So if you'll bring this study to us in May, and then I would like to request, Madam Chair, that in May we place an executive session on the agenda to discuss the research and data brought forward to us.
And Madam Chair and Member Sanchez, I actually have some information that I've collected already that I can share, and I can try to keep just a few minutes of all of your time. So when I came on board to just over a 30% vacancy rate. My first week, one member of our team said that they were leaving, and they did leave because of compensation issues. Another member of my team came and said, I just got offered more money, I think I'm leaving. That person has not left yet. I am trying to retain them, but compensation issues are significant. I mentioned we had a 30% vacancy rate when I came in. Even at a 0% vacancy rate, I can unequivocally say we'd be understaffed. I took a look at what our peer funds were doing in terms of compensation because I wanted to find out why we were losing people. Because I also took a look at our investment team and saw that quite a few members of our investment team are new because of turnover. They haven't been there for very many years. And in finding out why they left, one primary reason was compensation. So we're the third largest sovereign wealth fund in the country. The fourth largest is not really a peer because they're about half our size. We're not too far behind the Alaska Permanent Fund. We are so close to the Texas Permanent School Fund that there's a very good possibility in the next few years we'll overtake them and become the second largest sovereign wealth fund. So we have two peers. So I took a look at the compensation levels for all of the positions that are published for those two organizations. In public session, I don't want to go into most of the compensation for my staff. I'd be happy to cover that in a closed session, but it is very easy to find my compensation and Vince's on the Sunshine Portal. My peers at the Alaska Permanent Fund and the Texas Permanent School Fund are both paid $400,000. Vince's equivalent is paid about the same. With the Alaska Permanent Fund, the position is paid slightly less than the director. With the Texas Permanent School Fund, the position is paid a little bit more than the director. And there's a cascading effect that goes down the entire chain of employees. Both the Alaska Permanent Fund and the Texas Permanent School Fund have asset class directors that make more than Vince and I do. They have investment officers underneath that make more than our asset class directors do. It goes down the entire chain. You, as the council, have the authority under statute to set my salary. Under statute, I am responsible for managing the rest of the staff. With the court case that was resolved last year, and through consultation with our esteemed general and deputy counsel and general counsel for other key state agencies, there's been universal agreement. That means that I do have the authority to set salary and staffing levels for the state investment council. I'm working through the state processes to actually do that because it requires changes to how we actually interact with share. But the plan going forward is to create SIC exempt positions that would replace the governor exempt positions, and optionally classified employees would have the choice to move into these SIC exempt positions as well. It would be their choice. They could remain in classified positions if they wish. I'm currently hiring for an HR manager to help put together a whole host of policies because we will no longer be subject to the policies of SPO or the policies of governor-exempt employees, and put together pay bands, classifications, job descriptions, job titles, all of that. So that's gonna be a massive undertaking for the new HR manager and me over the next few months. But we're still limited because you all essentially set what that cap is at the top. And the cap at the top that you have set is below the level of asset class directors at our peer fund. So, I want you to be aware of that, that we are paying across the board significantly less for every employee than our peers are paying, and we compete nationally for this.
Madam Chair, I couldn't agree more with member Sanchez. This needs to be adjusted, and the sooner the better.
I have a couple of comments. When we're looking at it, I think we need to look at it holistically because their economy is very different from New Mexico. So if you're doing a compensation study, making sure you're looking at their economy versus ours, their hourly rate versus ours, so that shows you more of a percentage apples to apples comparison. The other thing I would say, and I would like to know if Secretary Cox thinks on this too, is DRB and Tara are also looking at this because of the court case. But you have to tread very lightly because I think it's important to have that conversation with the governor's office as well, and the legislature, because of the fact that they can change the way that this council moves and how it operates based on who they appoint, because they might not like that there's not any type of oversight on the compensation side. On the other end, for those of you that don't work in state government, SIC is like golden egg compared to all the rest of our staff. My staff gets paid that actually invest in-house between $50,000 and $85,000 less than what someone in the investment team at SIC makes. So putting those thresholds up higher also puts me at risk to lose my staff because they could potentially want to go to SIC to get more money, or para, or ERB. So that's putting a concern on my end, specifically as a treasurer's office, that we're going to lose really good long-term staff that have been there because I can't even pay close to what SIC is currently paying at this moment. So, and I think even just having like the HR manager and all of that, before you're making that move, I think that's something that the SIC has to agree to, because that could be a fight with the governor's office. And if the SIC needs to make that decision with you, instead of just going rogue and saying that court opinion came out, so this is the way we're going to do it. I think that's a more thoughtful conversation needs to be happening in the executive meetings that we have to make sure everyone's in alignment and how that's going to look moving forward. And then that's a bigger picture to where we're at budget-wise, because you still do get your budget from the legislature. So if you increase those salaries, but you don't get an increase from the legislature because they're not happy that they're not part of that anymore, that's another conflict to have. So I just think there needs to be more conversation than, afterthought, let's talk about this at 2 o'clock.
And Madam Chair and Madam Treasurer, so hitting on a couple of items, this doesn't change any authority of the legislature. The legislature sets our budget now, and they will continue to do so. The legislature has zero input on governor-exempt salary levels. They also have very minimal input on classified positions and salary levels. So, all of our upper-level investment team, all of our management team, they're all governor-exempt employees. The legislature has no input beyond the overall budget, which we would still be subject to.
But if they don't give us money, how do we pay them?
Well, that was limited bar authority.
Madam Chair, if I may.
Yeah.
Oh, wow.
Madam Chair?
So I brought this forward.
Member Tina, we'll get to you right after Member Sanchez.
I brought this
Thank
forward
you.
at this hour because that's the order of the agenda for new business. And I know we cover a lot, but, in my experience in managing people and bringing people forward, sometimes you have to set the bar, and you set the bar and then the state follows sometimes also. So I would feel very, as a member and as a trustee of this organization, that we would be jeopardizing the future of that fund and the prosperity of our state if we don't take the leadership in keeping staff, because we're going to have a revolving door there. I mean, you can see it. You go in there, you get those 2 years experience, and you can write your job wherever you want to go. We are in the big game with $100 billion, already $53 billion, $100 million. And if we go to our core values, interesting, I didn't like our core values when I first read them, but it kind of does make sense, you know, a fund that's, that's respected on the vision. A sovereign fund that is respected, and I really didn't know what that meant, but I think I'm learning what that means, is that, we're watched by around the world. I was interested in how it goes on the line, who clocks in. It's everybody borrow money. Everybody come get money who's on the website, on the webcam. We're being watched, and it's time for us to do this leadership. Because, and our state does have to look at salaries throughout the whole thing, because there's a reason why there's billions of dollars coming because of good management of our land. Billions of dollars coming into this organization. And now the prosperity of our children are depending on this staff and our decisions. And I'm the first one to admit, I'm making decisions based on the experts and the consultation that they're bringing to us. But if that's going to be a revolving door, New Mexico, we're going to fail them. We're going to fail them bad. And so it's a bold move. I'm asking to have that on an executive session on May.
Well, let's hear from Member Messina.
Thank you, Madam. Yes, thank you, Madam Chair. I just want to say we have been incredibly lucky that we have the quality of staff that we have. But in the future, we really risk maintaining that if we are not competitive with funds of our size. They don't only have the option of going to other funds, but they can go to the private sector. I am adamantly in support of getting our salary levels up significantly to be competitive with those comparable funds. Thank you.
So what you need from us is a contemplation of where the cap is right now. So what do you propose?
So, Madam Chair and council members, just to be clear, I can't move forward with this without you, because I would end up with significant pay compaction issues that create their own problems. So you do get to make the choice here. I'm planning to move forward with these SIC exempt positions, but I'm extremely limited as to what compensation I can pay for two reasons. One is, what budget we have, and yes, we do have unlimited budget authority, but I also do want to go make the case to the legislature for what budget we should have, what we would need. But also, by setting that upper level, that then informs where I can set everything.
So you have a request from a member. How would you like to proceed with that request?
I think his suggestion for a closed session discussion would be ideal, so I can go into.
Is that enough time, or would you do it sooner, or later?
I could do next month.
April? So then let's do May.
I mean, or
Let's do
April,
May.
May.
Sure, that sounds great, Madam Chair.
Madam Chair, we may want to check with General Counsel on this. I'm not sure a general discussion of compensation falls under the.
We're talking about that right here.
Yeah.
I think that's a discussion that we not only should, whether we can or not, it's a discussion we should have in public. When it pertains to individual employees, that's different. But if we're discussing salaries at the SIC, again, the taxpayer dollars, that should be done in the open session.
But the executive session would be, for me, concerning Mr. Clark. That's a single person that has to be in the executive session.
It would be limited to that.
Madam Chair, this is not taxpayer dollars. This is fund monies that pay these salaries. And if we're going to expand the way it looks like we're going to need to expand staff, this is a critical problem for us.
All right, so we are not going to solve this now. Yeah. On our authority, is it for anything, or including salaries?
Madam Chair, as I understand it, both the SIC, the Public Employees Retirement Association, and the ERC are the same bar authority, which is essentially a, because it's not general fund, so.
All right, so what we're gonna do is it's possible to put an agenda item on April's meeting to actually figure out what we're gonna do, whether or not we have to have it in public, what the next steps are, that kind of thing, okay?
Yes, Madam Chair, we'll take care of that.
Okay.
I'm happy with that, Madam Chair.
Okay, great, thank you. I appreciate your request. I second your request.
Oh, great.
Thank you, Madam Chair.
All right, next SIC meeting is Tuesday, April 23rd. Charlie, do we have anyone signed up for public comment? Okay, hearing none, I'm going to make a motion that we are adjourned. I mean, I'm going to declare that we are adjourned. We're not going to vote on it.